The U.S. growth story is still alive, but so too is inflation. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Vonnie Quinn, and we are counting you down to the closing bell right here in the United States. Well, it's all about capital markets activity today. We have the S&P and the NASDAQ 100 up. The S&P obviously doesn't have ARM in it, but the NASDAQ certainly does. So you can see there's other things going on as well. Economic data, for example. Data showing that the consumer is remaining resilient with retail sales up 0.6%, which was a little bit of a nice surprise. Also, those initial jobless claims came in a little bit lower than anticipated. So the labor market, whether we wanted to or not, is holding up. The 10-year yield and the 2-year yield obviously higher. 2-year yield above 5% right now. And I wanted to point out the dollar index because this is really a euro story today. We got the ECB hiking by 25 basis points and signaling that growth, if at all, is going to be very, very sluggish. And there will very, very likely be a pause next time round.
Yeah, starting to see maybe a little bit of a divergence in the U.S. and the European stories. Back here in the U.S., we did get the latest batch of economic data, a mixed bag to be sure, but it's still skewing towards the positive. Investor attention squarely on the retail sales numbers that dropped this morning. Retail sales numbers that show consumption still resilient, even in the face of a re-acceleration in consumer prices and, of course, those producer prices that we learned about this morning. A modest bid to equities this Thursday that actually has the S&P, believe it or not, poised to log its best day of September. Salita Marcelli, CIO of the Americas over at UBS Global Wealth, she actually says the data supports her view that the U.S. can maintain moderate growth and avoid a recession over the next 12 months, though she does caution that the still lingering uncertainty about Fed policy likely to keep the broader equity markets range-bound. So if they're range-bound, that means returns might be limited. Does that mean you go in and buy bonds? Ray Dalio says no. The Bridgewater Associates founder said he doesn't want to own bonds and prefers cash instead, highlighting a lot of the difficulties investors have right now as global central banks try to manage inflation and, more importantly, manage those expectations. Meanwhile, let's focus, I guess, on the positive, and we're going to start the big show today, Vonnie, with, I guess, the biggest IPO of the year. ARM Holdings actually making its debut, pricing at 51, opening at roughly about 56, and right now trading just below 60.
Exactly. A victory for Masayoshi Son and also for some of the AI players, right? Romaine told you the basic details here. We have 90% still owned by SoftBank, so this is a boon for SoftBank. And we have shares trading intraday still up almost 17% at this point. We're talking about a market cap now that's more than $60 billion. And Masayoshi Son himself was the one who said, you know, don't go for too much. Don't be too greedy here. It's only going to cost maybe $100 billion at the most if we just go for it right underneath what he thought was the right price to go for. So right now, market cap of $61.3 billion. Employees and all of those who've been waiting right through the pandemic for this to go ahead, very happy right now.
Our very own Caroline Hyde, the co-host of Bloomberg Technology, was actually down at the NASDAQ for the big fireworks today. Caroline, you got to sit in as a fly on the wall for what is the biggest IPO of the year.
Had we forgotten how it was done?
I know, I forgot. I forgot, remember?
I mean, we all were like with bated breath, so exciting, and remembering actually that these things take a while to open. It took until about midday for actually us to start to get a price. And ultimately, that's because from their position, they have to ensure that they're aligning the buyers and the sellers. In this case, there weren't so many sellers. Remember, there's only less than 10% in a free float. They'd got lined up some really integral backers, the likes of their clients, like NVIDIA, of course, the likes of Intel, TSMC. Who was going to be selling out in this position? Well, when you're getting the offering of a 17% uptick in terms of the price, clearly there were some sellers to be had. But this is a company that's really had to sell a vision of artificial intelligence. And that's exactly what Rene Haas actually said to me. It's in everything. Just take a moment to listen to him.
Investors really wanted to understand the opportunity we had in front of us. And of course, AI, which you can't really talk about our industry without talking about AI. And I think helping them understand that you can't really run AI without ARM, without a CPU, and just pointing out to them that it's everywhere in every device that people touch was a big part of the process for us.
CEO of ARM, speaking daily to Masayoshi Son, of course, of SoftBank. And ultimately, this is someone who's having to spell a vision when actually revenue has been curtailed of late because, of course, they're so ubiquitous to smartphones. That's been a shrinking market.
And why it's so interesting right now is that we are having investors trying to find a valuation out there in the public markets. It may only be 10% of the shares, as you say, but they're trying to find what the correct valuation should be or where the bid and ask is. At what point will investors demand to see more from ARM?
Well, when they start having to publicly file and they get their quarterly results. The quarterly results have already been guided to the upside. Now, remember, this is a company that in the previous quarter had seen slowing revenue growth. They're actually saying, no, we're going to bring it back for you. We're going to see 11% maybe in the next quarter, then bring it up to 25% growth because of the necessity to have their CPUs, their times of chips, alongside GPUs within artificial intelligence that's become, the linchpin of the market at the moment, Romaine.
I am curious. I mean, you sat down with the CEO, and let's face it, he's not a household name for a lot of folks.
No.
Of course, we know Jensen Huang has become a household name. A lot of other folks out there, Linda Su, a lot of other folks in this space, particularly in the AI space here. We talk about the salesmanship that is needed right now, at least at this stage of AI development. Does he have it? Does he have those chops?
He's, I have to say, very humble. He was saying, I've got people, my college friends, calling me saying, I had no idea, of course, because it's a B2B name.
Yeah.
It's not one that we realize is actually in all of our phones, ultimately, their technology. But he is saying now, this was the first roadshow he's ever been on. He's having to get out there as a CEO, sell his story, and from the pop in the stock, and the fact and the art and the science of pricing these things, he's managed to do it right. I think he will become a household name. ARM is ubiquitous to, well, everything that we use. AI, it's also going to be the metaverse, potentially also our Internet of Things.
All right, Caroline Hyde, who's been all over the big story of the day, the debut of ARM here in the public markets. She was down at the NASDAQ market site a little bit earlier. We're going to continue our coverage of what's going on with the biggest IPO of the year, maybe breathing some life into the broader market longer term. Meanwhile, we do want to go back to the broader market, the economic data, and some of the macro wins that seem to be steering things as well. Kara Murphy, she's the CIO over at Kestra Investment Management, joining us right now here on the big program as we kick you off to the close. And let's start off with the economic data that we got this morning, Kara. There was a lot of talk yesterday when we got those CPI numbers that it didn't really give the market any real clarity as to how good the economy is and, more importantly, what the Fed might do next. Do you think that changed at all with the data we got this morning?
I think today's data thread this really sort of good story in terms of not too hot and not too cold. So it continues this idea that we're seeing decelerating level of inflation, moderating in the labor market. We're still not quite where the Fed wants us to be, but at the very least, it buys the Fed time to allow interest rates to hold steady with where they are right now and allow kind of like the economic story to unfold on its own. So I think this is about as good as the market could have hoped for today.
And then, of course, everyone is sort of trying to look around the corner. This idea of, is a recession coming? Even if it's not a recession, the idea that you might necessarily have some sort of downdraft, I guess, in the economy that could have a material impact on asset values.
So we still believe that there's going to be a landing at some point. We've characterized this as a delayed landing. There's certainly been a lot more momentum in the economy than we might have expected at the beginning of the year. But the fact is, interest rates have been extraordinarily higher than what we've seen over the last decade plus.
Yeah.
And I think, we talk about these long and variable lags in monetary policies, and this is the lag part. So it doesn't mean it's not going to eat into economic growth, but that it's taking some time to get there.
Kara, just going to have to pause this conversation for just 1 second here. Some breaking news. Shares of Disney spiking higher. We're learning based on Bloomberg reporting that Walt Disney is considering selling its ABC television network. This is according to a person familiar with the discussions that our Bloomberg reporters have spoken to. I will read this verbatim. Walt Disney has held exploratory talks about selling its ABC network and its TV stations to local broadcaster Nexstar Media Group. These talks are preliminary, and we should point out here that it's not actually clear if anything will get done. But our reporting says that Nexstar is interested at, quote, the right price. So once again here, Vonnie Quinn, the big story here, and this would be a big deal, it should have come to fruition here. Disney, the owner of the ABC network, has already held exploratory talks about selling off that network and its TV stations to local broadcaster Nexstar Media Group. Disney shares have spiked up about 1% here just off the back of that.
And let's not forget, Romaine, they're down 25% year over year. Disney has not been doing well. And back at Sun Valley, when all the billionaires were gathered, the talk, the speculation was that there would be conversations perhaps between some of these executives, between some of these cable news executives. And what might Bob Iger do? Who might he want to talk to? What portion of Disney's business might he want to go big on or get rid of? And ABC was among those assets. There was also the question of whether he might actually buy the rest of Hulu.
Yeah, there's been a lot of talk about those broadcasting cable channels. Of course, a lot of talk about ESPN and the structure of that, whether that gets spun off or even sold in some form or another. But I think what has been clear, at least based on what Disney has articulated publicly, is that the current structure of that company is going to look a lot different at some point in the near future, and at least based on the current reporting that that we have here, Vonnie, we're learning that exploratory talks have already been held about getting rid of ABC.
And Romaine, just think of what that might mean for the cultural and social landscape of America. I mean, ABC, the network broadcaster for
and it's hard to kind of not put the exclamation point on this, because I mean, you're old enough to remember when all these sort of networks kind of came together. Remember, everything was so disparate, and then you had sort of this golden age of sort of the conglomerates of media companies, and Disney was sort of out in the forefront of that. So obviously it had the ESPN channels, ABC channels, the parks business, and all this stuff, and it put all this thing under one umbrella that was supposed to be more efficient, both from a revenue perspective and a profit perspective. But we know the media business has changed dramatically over the last 10 years.
And we know that they brought back Bob Iger in order to try and sort this problem out, right? Disney did not do so well under its predecessor, who was there for just a couple of years before Iger had to come back. Then Iger actually extended the amount of time that he decided he was going to stay, and now there's a question mark over at what point he will go. But he certainly hasn't turned things around enough yet in order for him to feel comfortable to quote unquote retire or move on to his next chapter. And clearly, if this is being reported, Romaine, you know that things have gone on beyond initial talks.
Right. When I hear that the talks have already been held, that means that this is more than just an idea.
Exactly.
That they're basically looking for the right buyer and the right price. Now, we should point out, you're looking at Disney shares there, up about 1% here. Almost all of those gains came on the back of this news. We should point out Nexstar, which was already up about 3 or 4% on the day, spiked higher by as much as 12%. Those shares have paired some of those gains, but still up about 4% here. So investors very in tune right now here to what this could mean for both companies and whether it could mean potentially, Vonnie, a net positive, right? Because typically in these types of scenarios, you typically see the acquirer shares go down and the seller shares go up. But in this case, both are going up on the prospect that this deal could potentially happen.
But it's really interesting that Nexstar would be the choice. I mean, according to this story, and of course this is all preliminary and this is not happening yet, it's just exploratory, but it's the largest U.S. owner of TV stations.
They've been very acquisitive, though.
Exactly.
Remember, they bought a lot of stuff from, was it Warner Brothers, right? If I remember correctly, and from Paramount as well. So they've been buying mainly local channels here, but nevertheless, they've been a big investor in this idea that linear television, at least from the perspective of local news and sports and things like that, there's a future there, and they've put a lot of money into it.
So are we talking about the future moving just somewhere else, or are we talking about linear TV going away and perhaps this becoming a whole, like, smaller universe?
I think it might have to do with more with who wants the headache, right? If Nexstar thinks they have the management expertise to sort of navigate these waters, which you know are different, and Iger doesn't want that headache because he's got all these other trophy properties, then maybe, just maybe, this makes sense. I'm told we have Chris Palmieri, who helps lead our media coverage all out on the West Coast, joining us right now from our camera in Los Angeles. And Chris, I guess this is a surprise, and I guess it's not a surprise. We knew Iger was certainly kicking the tires of his own company, trying to figure out what might have value outside of it.
Yeah, rumors about a deal like this have been going on quite a while. But the difference is, we saw in July Bob Iger coming out and saying, hey, this is probably a business we don't want to be in long term, the legacy media networks. And so we know they've basically been up for sale. And, you saw the former president of Nexstar at a conference yesterday come out and sort of beat the bushes for a deal. He said, we could do this. Be minor divestitures we'd probably be required to do. There's some complications, such as, how you deal with sports that originates on ESPN, but also is simulcast on ABC. But he very clearly said we just like a little more guidance from Disney on what their plan is here. But definitely something they would be inclined to pursue.
What does it mean for the universe going forward? I mean, the broadcasting universe, Chris, because you have ABC, sort of the quintessential American broadcasting corporation, going to Nexstar, which already owns, as Romaine said, several assets, including News Nation, for example, the cable channel. So potentially it could stay the size it is. It could keep the audience it has potentially. But then do you have Disney doubling down on the streaming type services, the sports type services?
That's exactly the indication that Bob Iger has given, is that they want to focus on streaming. They don't want to get rid of ESPN. But the drag that is the sort of shrinking business of traditional TV is something that they don't necessarily need to be in. And Nexstar's obviously whole business is traditional TV, and they have been getting deeper, as you noted. They acquired the CW network last year. They have News Nation, a cable news outlet. that they're growing. And so this really fits. I mean, a lot of times companies do sort of stupid acquisitions that's outside of their core.
Yeah.
But for Nexstar, this is their core business. They employ tons of news reporters around the country. They have advertising sales staffs that sell local TV advertising.
Yeah.
So this really isn't that much of a stretch for them and really could elevate and distinguish their product from others.
Chris Palmieri, our man out in Los Angeles, here with the big news of the day. Right now, Disney said to have held initial exploratory talks on the sale of ABC to Nexstar. Shares of both companies higher here in the cast session. Stick with us. A lot more coverage coming up after the break. This is Bloomberg.
The European Central Bank has raised interest rates for the 10th consecutive time. Earlier today, Christine Lagarde was asked if the ECB is done hiking for now.
Focus is probably going to move a bit more to the duration, but it is not to say, because we can't say that now, that we are at peak.
Joining us now for Insight is Ludovic Subran, who is Chief Economist at Allianz. Ludovic, is the ECB done?
We think they are, but the question, and I think President Lagarde is right, is now how long can they hold the rates high like that? Because 4% for Europe is quite high. We're in recession already. Germany's in recession. So I think the question now is the pivot next year, right? But I think for now they're done. Of course, the Fed is, in everybody's mind. If they skip and hike in November, maybe Europe will be pushed for another hike because we have still 2 points more of inflation, and we're still 1.5 point lower when it comes to rates.
How much does the next decision depend on the Fed? Because if the Fed starts to cut, that could also help Europe at some point, right? So can the ECB perhaps wait through a potential next hike?
I hope so. That's my hope, just because I believe now the risk of policy mistake is very high. So the ECB, we have very different economies right now. The US is still growing, expansion is strong in prices, in growth. I think we really have a different, trifecta of growth, margins and wages in Europe right now. So I hope we can see through. But again, how long are we hold tight? And the pass-through is visible for corporates, for housing sector. So, yeah, we're not done, but we could be done. The question now is what happened in 24, because it's a very long year for everybody, with elections here, election there. Can we hold still, and does it bear some form of recessionary risks?
But that's a big question, because everyone's talking about the peak rate already, right? They're basically saying that we're near there, right? Like 4%, I think is kind of the consensus here. Do you buy into that consensus?
I think it's a lot for Europe.
Yeah.
Again, we have zero growth for the past couple of quarters in most of the big countries.
Right.
So it is peak rates. The problem is the risk that markets mistake these peak rates being lower for Europe than the US has.
Right.
Confirming the stagflationary recession, because we still have too much inflation.
Well, but contrast that with what's happening here in the U.S., because when the Fed embarked on this rate hiking cycle, everyone assumed the economy was going to break. Now, here we are, 5.5 percentage points later. The economy is still holding up. It's certainly not as healthy as it was, but no one's really calling for a whole lot of gloom and doom just yet.
Well, again, the sources of inflation matter. We had 2/3 of the inflation coming from a supply shock that is far from being done. You see what's happening now on the barrel of oil, right? So I think the problem is it's not up to the Fed now. It's up to the fiscal policy to be able to withdraw slowly but surely without breaking the economy. And we've seen in Germany, for example, the recession happened the moment they started to consolidate a bit too fast on the fiscal side. And of course, all countries now also, debt servicing is high for every country. So they're all adjusting at the same time. So there is this risk that the economy doesn't hold as strong in Europe as in the US. We have a regional energy crisis that you guys don't have. And so the question is how we navigate that. Yeah.
And the engine of Europe, Germany, is really, really suffering, which is the frightening thing. Back in the US, today marks the 212th day that the curve is inverted. That's a record, going back to when records began on this kind of thing. What is it telling us?
I don't know, not much more, right? I mean, the problem with the curve is that it's been inverted for too long. The joke among economists is that it tells you there's going to be a recession. It never tells you when. I think if I were to look now at the US, I would look at jobless claims and I would look at credit spreads. These, for me, are going to indicate where we stand on the cycle. I'm very worried about 24. It's going to be an ultra-long year with the elections. It looks to me like a remix of 2016 when we had Clinton against Trump, and it was, this muddle through. And it reminds me somehow also of 2001 when the recession was only confirmed quarters after it actually happened. So stay put. I think the U.S. economy is slowing down. It's going to be borderline recessioning.
Clarify more what you mean because it's an election year. I mean, why does it matter that it's an election year?
Because, there's been recession avoidance syndrome everywhere through fiscal. This country is avoiding recession because of fiscal. There is very strong private sector consumption and investment, but when we look at the number, there is still a lot of fiscal stimulus. And so the question is that in an election year, everybody is calling now, very bipartisanly, by the way, for fiscal consolidation. So a lot of the investment decisions are going to stay on hold till they know what type of tax regime, what type of expenditure, if IRA is going to be repealed by the Republicans or if the Democrats can actually continue to disburse. All of these decisions are going to push, investment and by the firms and by households a bit forward.
All right, Ludovic, great to talk to you here. Ludovic Subran is chief economist over at Allianz. A look at some of the broader macro conditions, particularly over there in Europe. Back here in the U.S., still some concerns about what's going on with the labor market. A deal between the United Auto Workers Union and Detroit's big three automakers appears to be nowhere in sight with less than 10 hours until that deadline. Detroit Bureau Chief David Welch joining us right now to talk a little bit more about what we know as we count down to midnight.
As we heard from UAW President Shawn Fain last night, he's getting his people prepared to strike, and as he said, strike like they've never been struck before. I'm paraphrasing a bit, but he's not only got a different strategy, but he is really prepared to go all out, possibly strike all three companies. And he had very fiery rhetoric. It doesn't sound necessarily like somebody who thinks they're close to a deal. That said, General Motors has a new offer on the table today. We may get details of that later today. And Ford has offered 20% pay raises. General Motors and Stellantis are pretty close to that. That's a pretty generous raise, 20% over 4 years. I think it's better than they've gotten in all the years I've been covering labor talks. The sticking issue here could be whether or not they're going to give pensions to workers who were hired after 2007. That's one of the concessions the UAW made a decade and a half ago. They want it back. The companies want nothing to do with pensions and retiree health care. They think that's what drove GM into bankruptcy in the first place. So that could be the big sticking point tonight.
David, does Shawn Fain have enough support to keep the workers from all of the plants and all of the car makers aligned? Because if one breaks, that's it, right?
Well, look, he has enough leverage to get workers to stay out. I think where it becomes a test for him and a test for the union is, right now, because he himself has been negotiating, putting out his demands in public, the companies have been putting out some of their counter proposals publicly, and they include some pretty nice raises. If the workers are out for weeks and they see that they could, go back to work and get a great raise and an offer that they like, do they start pressuring union leadership to end the strike and go back? It would take, I think, weeks for that to happen. There's a lot of anger among union workers to stay out, so it would take a while.
All right. Well, it'll be interesting to see what happens when we get to that deadline. David Welch, our man out in Detroit, keeping an eye on this with the deadline at midnight as the United Auto Workers preparing to hit all three of the major U.S. automakers with targeted walkouts at strategic locations. Another sign of the power that the labor movement feels that they have in this moment, Vonnie, a time where the labor market is strong. And it's not just in, I guess, the more private or, if you will, adult markets, if you will. Interesting story in the Bloomberg terminal about athletes at Dartmouth College basically saying that they want to unionize here. This is the men's basketball team at Dartmouth College. They've actually petitioned to unionize. Now, if it's successful, it would be the first Division I team in college athletics to actually have a union.
Well, and it's another way, another legal way for athletes to get recognized, right? School and college athletes to get recognized, to get paid, because their whole day is basically dictated by what could be termed employers.
And this caught my attention, too, because several years ago, my alma mater, Northwestern, there were a group of football players that also tried to do something similar. And they were rejected by the National Labor Relations Board because they said, well, technically you're not employees, so this doesn't apply to you. Now, we know since the Supreme Court ruling with regards to names, images, likeness, that sort of changed the definition of what these athletes are. So maybe the end result is different this time around.
There's going to be a big fight because colleges could lose their 501(c)(3) status.
Oh, it will be a big fight, to say the least, Vonnie. We have a lot going on here today at the ARM IPO, news on Disney, and as well as just the general market movements. Stick with us. Romaine Bostick alongside Vonnie Quinn. This is The Close. This is the countdown to the close. Romaine Bostick here alongside Vonnie Quinn and I on the broader market. A relatively strong day in equities on the back of the latest retail sales numbers. Let's take a look at what's going on in the commodity space, though, right now. Abigail Doolittle standing by with our commodities close.
And so it is a bit of an unusual situation that we have today, Romaine, because the dollar is higher on the day. And it's very interesting because the DXY, with that heavy euro weighting, well, it's up 0.6%. The BBDXY, the Bloomberg Dollar Index, which is has less of a euro weighting, up 0.25%. But either way, a strong dollar should not have this kind of a rally for commodities. So this rally that we are seeing, this green on the screen, really confirms the risk-on tone that we have for stocks. New York crude, importantly, back above $90 a barrel for the first time, basically since June of 2022, joining Brent crude. And technically, it appears like this rally will continue. Gasoline also higher, and this is, of course, one of the inflation pressures we've been talking about this week. We also have some strength here for some of the industrial metals, nickel and aluminum. So that really speaks to the idea of this risk-on economy idea. Now, this is interesting. Here in the U.S., U.S. natural gas futures up a little bit. European natural gas, though, down 3.5%. They, of course, have been rallying on the Australian strikes that could take some supply off of the market. But now, apparently, there's a U.S. facility that's coming back on, bringing these European natural gas futures down. As for some of the grains, a bit of a mixed market here for the likes of coffee and sugar. We have some gains. Sugar, of course, as the India output fears are overshadowing the huge Brazilian crop. And then finally, Romaine, wheat, it still cannot get a bid. On the since its peak back in July, it's down 25%.
Wow. All right, Abigail Doolittle, a nice wrap up here of what's going on in the commodity space. Of course, one of the big headlines of the day surrounding oil prices, WTI firmly above $90 a barrel. Let's turn to the consumer product space right now in the highly competitive market for high quality headphones. Bose, of course, is at the center of that, just announcing the next generation of its popular noise canceling headphones and earbuds. The top models feature a new immersive audio technology that Bose developed to compete with spatial audio from other brands. Joining us right now, I'm pleased to say, is the CEO of Bose, Lila Snyder. Great to have you here in the studio.
Thanks for having me.
Absolutely. I think we're all familiar with your brands. Vonnie was just crowing about her noise-canceling headphones. But what I'm interested in is this new technology that is in this, because I feel like we've gone from a different iteration of noise canceling. I mean, I know spatial audio has become a thing. Yeah. Explain what the technology you're using now in the headphones.
Yeah, so Quiet Comfort headphones will give you everything you expect, right? Amazing noise cancellation, great quality audio. The new feature is immersive audio. And think of it as taking the sound from being inside your head. Usually when you're listening to headphones, you feel like that music is right inside, and bringing it out in front of you so that you feel like you're listening to two amazing speakers and you're sitting right in that sweet spot. Really creates a spaciousness that I personally love.
I am curious about just the competition in this space. I mean, for a while, Bose was kind of synonymous with, high quality audio. That was partly because of your innovation, but also because there weren't a whole lot of other players. I mean, you had some really high end players out there like Harman Kardon and a few others. But now I feel like everybody's trying to get into this space here. How do you handle that?
I think what's so unique about Bose is we are focused only on audio. So for us, audio experiences is what we're obsessing about every day. And our customers are music lovers and our employees are music lovers. And so I think what makes us truly distinctive is we're focused on innovation to make those music lovers have the best possible experience with their headphones.
You're literally a PhD in mechanical engineering from MIT.
I am.
And you worked at Pitney Bowes before this, which is all about supply chains and getting things to places they need to be. How are you now at Bose thinking about China and this decoupling, this deglobalization and what's happening there? Because you have factories there too.
So I think everyone through the pandemic and what followed in terms of global supply chains is really thinking about agility and resiliency in their supply chain. And we're no different. We're thinking about how do we make sure that we can consistently get our great products in the hands of our customers.
But are there problems out there still, though?
So far, not really, right? We feel like the supply, the commodities have eased, freight has eased. So we're finding it a much more amenable supply chain now than what we had before. There are still some issues in spaces, but it's improved dramatically. And I think our ability to handle those tiny shocks when we have them has increased dramatically.
I am curious about, I understand that there's probably a customer that gravitates to Bose that is probably maybe a little bit more immune to economic conditions. But at the same time, I'm sure you have to be kind of tuned in to what's going on with the consumer, what their capacity is to spend here. What does the economic landscape look like to you?
We see sales are still really strong this year. It's continued throughout the year. We're growing. We see strength going into the holiday. And this is really a category that's a passion point for consumers. And they're willing to, they don't want to compromise when they think about premium audio. If they really love music, they want to make sure they're experiencing that in the best possible way. And we see the consumer really showing up very strongly in our categories.
I am curious about just your tenure. I think you've been at the helm for a couple of years now here.
3 years, yeah.
3 years, excuse me, at Bose. One of the early things that you did, you established a marketing officer position, which was new to Bose at the time.
Yeah.
And I remember reading about him and I guess some of the challenges that he would have to take Bose from its former corporate culture to what it is now. How much has changed with regards to the outreach to the consumer and just the veneer of marketing that you're using right now?
What's great is the core hasn't changed, right? Really thinking about music and the joy that that brings to people. But what you can see in our brand and the way we're positioning it today is we're really trying to connect more emotionally with our customer. We've always been known for great technology and innovation, and that hasn't changed. But we want to help people see how these products make them feel, right? The music is so important to memories and all of those special details in your life. Music is usually there, and helping our consumers make that emotional connection with Bose is really where we've been focused.
What's your favorite music?
I love all music. I get that question a lot. One of the most fun things to do is to try our products across genres. You can really see how different genres bring different aspects of our products to life.
Listen,
so I like to
hide
test
it. It's out there. You're a fan of country music. You're a fan of some classic rock. It's all
I am. It's all out there. Yeah.
Little Taylor Swift in your household too, from what I...
Taylor Swift, I think in everyone's household this summer, no?
I think so.
Well, our congratulations to Lila Snyder, CEO of Bose, just on being the CEO of Bose, but also the Quiet Comfort Ultra headphones get launched today. So thanks for joining us.
Thank you so much.
Still ahead, investors are looking to Lennar's quarterly report to get a feel of the housing market. We'll preview what to expect when Lennar's results come out this afternoon. This is Bloomberg.
Let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start off with Carnival, the cruise line company, getting a buy rating upgrade today over at Redburn Dubai, which says the sector, the cruise line sector, has now, quote, exited intensive care from the pandemic days. Debt is falling, profitability improving, and margin growth, according to the analysts, looking good as well. Shares looking good, having their best day in more than a month. Next up, First Solar raised to outperform over at BMO Capital. This comes amid the continued pullback in the shares over the last couple of weeks, but BMO says this makes the stock's risk reward much more attractive. Apparently, some other folks think the same. Those shares having their best day since mid-August. And finally, let's take a look at Etsy, a rare upgrade for the company today to outperform from peer perform. This over at Wolf Research, which says despite the plethora of near-term uncertainties and the more than 45% year-to-date decline in the stock, there's still, quote, plenty of opportunities out there to improve margins if management gets its act together. Shares higher on the day by about 3%. And those are some of our top calls. We do want to stay in the sell side space and take a look at the home building sector. Lennar, to be specific, they're set to report earnings after the bell tonight. Let's get some insights out of our next guest. Jay McCanless joining us. He's Senior Vice President over at Wedbush Securities. Jay has an outperform rating on Lennar shares, and we're talking about a stock and, quite frankly, a whole home building sector, Jay, that has really been on fire despite all of the headwinds out there for the rest of the economy. Do you think that's going to continue based on what we learned tonight?
Yeah, we think so, and we're neutral rated on Lennar, but we are thinking that earnings tonight are going to come in about 20 cents or more ahead of consensus. We're at 373. We also think, from a volume perspective, that they're going to have more closings and more orders, which is kind of the initial sales contract that they sign. We think those are also going to beat consensus because what we've heard from the builders is that cycle times, which is the time from when you sign the contract to close a home, those have been coming down. And also we've heard that demand, even with these higher mortgage rates, has still held up. So we believe that's what we're going to see out of their results tonight.
I am curious, too, when we talk about, I guess, some of the longer term trends. I mean, we know that a lot of new home builders have really benefited from the tightness that we're seeing in the existing home sales space, the resale space, if you will, here. Do you see that persisting much longer term into the future?
It seems like it's going to stay that way. We continue to see new home listings, existing home listings declining by mid 20% and more, pretty much the entire summer. Actual inventories of homes for sale have shown the same type of declines. I'm not a rate forecaster, but I think if mortgage rates stay at this level, mid sevens for an extended period, that's just a disincentive for people to sell their home unless they absolutely have to. The good news for the home builders is that it's giving them essentially more shots at the consumer. New home listings in the first 2 decades of the 2000s, we're running about 10% of national home listings. And over the last, call it 6 to 12 months, new homes have been as much as 40% of national home listings. So Lennar and all the other builders that have great web presence, this is giving them more shots at the consumer and an opportunity, we think, to gain market share. Temporarily, possibly, but at least in the near term, gain some market share versus existing homes.
Jay, how much is Lennar having to discount prices or indeed pay down sort of mortgage rates? I understand that's something that these home builders can do as well.
It is. They haven't given us an exact percentage on the discounting, but I would say that a majority of the homes, they're either having to do some level of incentive, whether that's the mortgage rate buy down, which a lot of builders are using now. That's been a very successful tool at helping affordability. But then also we've heard from some of the other builders that they are giving incentives in terms of extra options in the house, because if people can afford the rate, whether it's a 6%, 7% rate, sometimes they're getting a little extra into the house. So yeah, what we think we're going to hear from them is that they're being fluid on both price and incentive to maintain pace. That's what Lennar likes to do, is maintain a sales pace using that pricing lever and rate buy downs if they need to.
All right, Jay, great to catch up with you. Jay McCanless there, neutral on Lennar here as we head into that earnings report after the bell. Full coverage coming up as soon as we get those numbers. Meanwhile, here on the big program, a discussion about the IPO market arm and whether this is the shot in the arm for the broader market. Kristin Roth DeClark, she's the global head of tech investment banking over at Barclays. She's stopping by the program next for our Wall Street Week Daily segment. Stick with us. This is The Close on Bloomberg. Time now for our Wall Street Week Daily segment here on The Close. The host of Wall Street Week, David Weston, joining us as he does every day at this time. And of course, this is actually a pretty big day. We had an IPO today, biggest of the year. But more importantly than just that IPO, there's a big question here about whether this signals a pickup in deal activity.
Yeah, it's a bit of a dry patch, hasn't it, Romaine?
Absolutely.
And the question is it going to change the world for IPOs?
Yeah.
Unfortunately, we have somebody who knows about that. She is Kristin Roth DeClark, Global Head of Tech Investment Banking at Barclays. Kristin, thank you so much for being with us. I know Barclays played a significant role in this IPO. It limits how much specific you can say. But first of all, what do we know so far about that ARM IPO? What does it tell other people in the market about IPOs at this point?
Well, I think one thing I will say for sure is the IPO market right now, this is a really fun time for me personally and for people like me to take companies public, because we have an investor universe that has to kind of look at everything because there has been such a dearth of IPO activity, but they don't have to buy everything. And so it really is a fundamental sale to the investors. And so you end up with these high quality orders coming in. It's not the FOMO world of, chasing momentum that we saw towards the end of, 2020, 2021. It is much more of a fundamental sale. And so what we get to do, where we, connect buyers to these businesses, you're selling something that they're buying something for 2 or 3 years out, not just chasing momentum.
So what has changed, if anything, Kristin? I mean, we have higher rates still. Those haven't gone down. There's still some uncertainty in the marketplace. Is it just pent-up demand? But why do you think it might be turning around?
Yeah, I think there are a couple of things that are leading to the investor appetite today. Partially, it is the fact that a number of companies that financed in, let's say, 2020, 2021 at multiples that are significantly higher than what we've seen historically and certainly significantly higher than today, have had the opportunity to really evolve their business models in a way to become, basically have some discipline around cost, get to profitability for a lot of these companies, and be in a position to where they are much more scaled and have cost bases that will allow them to continue to grow and be profitable. And so that's one thing that I think has changed. The other is I do think investors have more confidence in the levels that we're at from a valuation standpoint more broadly in technology, and are starting to see the competing tension in the public market of M&A from strategic, take privates, for example, or from take privates or from strategic activity leading into the end of this year.
Well, that's what I'm interested in, Kristin, here is about, I guess, price discovery. And we know that investors, at least for ARM and a couple others, have sort of found some comfort level with the valuations that they're getting. What about the flip side of that? How comfortable are the companies themselves, these private companies that are looking to go public, with the idea that their valuation is most likely going to be lower than the last private round?
Yeah. And that's going to be the case probably for the next year and a half, because of where companies raised capital in 2020 and 2021 and where those multiples were. There isn't a stigma associated with raising money at a lower valuation than your last private round. And so that's helpful. The other thing is a lot of these IPOs are small relative to the market cap of the company. So you're looking at very little dilution if you're selling any primary stock in the IPO. And it's more about where does this stock trade in the aftermarket? Who are the investors that are buying it, and are they really committed for the next 2-3 years of the company's growth phase, and less about what is the absolute price on the day of IPO.
If we are sort of entering an era where we're going to see more deal activity, whether it's because of ARM or maybe just because of macro conditions and the Fed are now maybe a little bit more favorable, does that necessarily mean everybody can come through the door? Because, I mean, let's be honest. I mean, there was a stretch in 2020, 2021 where there was a lot of garbage coming to market. And now what you've seen coming to market are much more mature companies, companies that have much more of a track record of revenue growth and profitability. Is that going to end up being the landscape?
I think that the bulk of the companies that have been waiting in the backlog for a couple of years now, that have really gotten, as you said, more scaled, they have a longer track record of growth at scale, and they have more discipline around profitability. I think the bulk of those companies are still probably going to go public next year, but they're gearing up now. And I think April is probably going to be a busy month, April-May timeframe, because that's really the inflection point of when companies can get credit pretty comfortably for the 2025 estimates. And so if you've waited this long to go public, getting credit for 2025 is certainly helpful. The conversations I'm having right now with companies and their boards about, do we wait till April, May type timeframe where we have full year financials for 23, we have recent developments for Q1 of 24, or do we hit this window? And the three things that investors, or that companies and boards, the three considerations for going earlier and pushing into this year are: one, you get investor focus. As I said before, investors have to see everything that comes to market right now. They don't have to participate, but they have to look at it. Two, you're building a shareholder base that is incredibly strong from a fundamental standpoint. So this isn't this, pile on momentum type investor mentality. It's a really strong shareholder base to enter your life as a public company. Yeah. And the third reason is, as strategic M&A is increasing, having a public currency in which to participate in that is a positive. So those are the reasons that people are thinking about moving from next year, April, to pushing forward to something, in 2023.
Kristin, you're head of tech investment at Barclays, and this may be talking your book, but how much of this is tech specific? We've been talking about IPOs more generally. Obviously, ARM is a tech company. There are others that are talked about in terms of IPOs, but we also have things like Birkenstock that at least I don't think of as a tech company. How much of this is specific to tech at this point?
I think the IPO investors tend to favor growth and profitability, or some combination of that. Historically, it was more growth. Today, it's more growth and profitability. You see a lot more companies come that are tech or tech-enabled, and consumer-facing businesses are probably, in the same way, have similar financial profiles. And so maybe it's a little bit more about financial profile and growth rate, confidence in growth rate, confidence in business, in unit economics that's fueling some of the interest from investors. But tech has touches a lot of other verticals, and it's been disrupting a lot of other industries. And so I think there will be a pretty heavy calendar on the tech side, probably more so than any other sectors.
And Kristin, I'll put you on the spot here at the end. Do you want to make a prediction with some of the ones that might be up next? I mean, whether they're your clients or not. What do you think might be coming? We hear about Instacart, for example, some others?
So I can't comment on specific names necessarily, but I do think some of the financial profiles that I described in terms of scaled, consistent revenue growth, in some cases accelerating revenue growth, and confidence around unit economics, neither profitable or very close to that.
I said I was putting you on the spot, and you handled it beautifully. Thank you so much, Kristin. It's Kristin Roth DeClark. She's Global Head of Tech Investment Banking at Barclays.
It was a nice try, David.
I tried. I had to try. You had to make the effort.
Try.
I wasn't sure I was going to get an answer, and I sort of didn't, but I tried.
I think she's too experienced for that to fall for that. But.
And then tomorrow we've got a special guest, Raj Shah, who's head of Rockefeller, used to be head of USAID. He's coming on to make a very special announcement, actually, on behalf of Rockefeller. And then on Friday, we're going to be hearing from Melissa Carney. She's University of Maryland professor, about the economic advantage of a two-parent household. Also hear from Ruth Simmons, former Brown University president, about the importance of college education. That's all coming up on Friday, 6 p.m. Eastern Time on Wall Street Week.
Be sure to tune in for that, and you can check out David Weston every day around this time, right here on The Close, for our Wall Street Week Daily segment. A very busy day in the markets today. Economic data to start the day, moving the markets, and then as the day went on, the debut of ARM in the public markets may be providing, a shot in the arm for future deals going forward. And learning just a little while ago, the latest news out of Disney, potential sale of its ABC networks, at least based on Bloomberg reporting. We have full coverage ahead as we round into the final hour of trading, with stocks up across the board here on this Thursday afternoon. The VIX tamped down, the dollar once again starting to show some strength, in your yield space, pretty much where it's been camped out, just a few days removed from the next big Fed meeting. Romaine Bostick here alongside Vonnie Quinn. This is The Close on Bloomberg. It's almost 3 p.m. here in New York City from our Bloomberg World headquarters. This is the countdown to the close. Let's get a view from the top here. Romaine Bostick alongside Vonnie Quinn. Vonnie, interesting day here in the markets. An up day, to be sure, despite the fact the economic data we got that provided the catalyst a bit mixed.
A little bit mixed. We did get those retail sales coming in better than forecast, which was consoling when it comes to the consumer, because we're all worried about the consumer right now, right? But we also, of course, had initial jobless claims coming in at 220,000, and that PPI data as well made a bit of a difference today. The PPI ex-food and energy month over month coming in at 0.2%, and that was down from 0.3%. Business inventories stagnant. So a lot of economic data to parse, but there was also, of course, the ARM IPO, which sort of gave a boost to capital markets action today, and you can see it in at least the NASDAQ, if not the S&P 500, which is up for its own reasons. Yeah, you can go ahead and flip it up. I mean, we talk about sort of what the ARM IPO could potentially mean for the broader market. Of course, it priced at $51. That was a little bit less than what they were marketing it at, but nevertheless, still pretty strong, coming in at the open at about $56 a share, and right now trading around 58. At one point, it was up around 62. So we knew there was going to be a lot of demand in the secondary market for this, and it'll probably take a few days before we get a much clearer picture as to how much people want to buy into this. But this is a sense here that a company, at least a good company, a company with a proven track record, can come to market and come to market in a big way. Exactly. A British chips designer, and don't forget, Masayoshi Son gave up on SoftBank for a little while to just go and concentrate on this ARM IPO. He has been missing from SoftBank's leadership. He's been trying to get this done. It's something that's been taking years, really, because he tried to sell it several times and it hasn't happened. And finally now we are seeing an IPO, 10% of the outstanding stock, and it's going well. All right. Well, that's certainly one of the big movers of the day, Vonnie. A few other stocks also getting a bid. Exactly, yeah. And you mentioned the cruise lines earlier, Romaine, with the upgrade, and that's one of the stocks that's doing so well as well. Just apart from everything else, we have Norwegian Cruise Lines up 5.8% on that upgrade, looking like the patient might be out of the hospital is really what I think.
Well, that's what the analyst said. Basically, that the intensive care phase of this for this industry that we kind of had during the pandemic, that's over. But we've joked a lot here about the idea that these cruise lines, they never really did poorly. I mean, obviously they had to shut down completely for a certain part of the pandemic, but anyone who has folks, I'm not a cruise person, but I have people in my family who are cruise people, and they were never going anywhere. As soon as the cruise lines reopened, they were back on.
Exactly,
yeah.
And obviously Caribbean Cruises and all the cruise liners doing so well, and they've got it down to fine art, you know.
Yeah. How are those cruises to Greenland going?
Not those ones so much, not those 30-day
Did they ever get that
ones.
ship out? Is that,
you know, I think it might be still stuck there,
Okay,
but they're having
right.
a good time. I mean,
Are they?
from what I can see in the windows.
Well, they have a great view, that's
drones.
for sure, where they are.
But, you know, there's a few stocks that are lower today, we should mention as well,
Yep.
and Netflix being one of them. And this isn't the first day of Netflix's decline. This is extending its decline, down 9% now over 3 days. The company not looking for dramatic growth in revenue.
Yeah.
HP on the decline too, Romaine, thanks to Warren Buffett selling a little more of his shares.
Yeah, Netflix shares are down once again here, one of the biggest decliners, at least on a point basis for the S&P 500, moving closer to that closing bell. Our cross-platform coverage, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Vonnie Quinn. We're joined right now by our colleagues Tim Stenovic and Simone Foxman. Simone filling in today for Carol Masser, our global simulcast here. As we keep an eye here on the broader markets, Tim, the big news, if you go through the Bloomberg terminal, the most read stories about Kristin Lagarde and the ECB hiking rates for 10 straight times, about the latest data out of the Fed, about Disney, about Sam Bankman-Fried. What are you looking at, Tim?
I'm looking at the sky. I'm looking at UFOs.
UFOs.
Oh, they're not called that anymore, Tim.
I know, that's true. I have to make sure I get this
that's
right.
That's offensive, I think.
UAPs, unidentified anomalous phenomena. Romaine, do you believe in I'm not going to say it right, guys.
Yeah, be
UAPs.
careful.
Do you believe in UAPs?
They have to be sensitive. Haven't you take sensitivity training here?
I have not taken the UAP sensitivity
You can't offend these
training yet.
otherworldly creatures. It'll probably take us all over. I mean, I don't know if I believe or not. I mean, is there any truth to this? Why are we talking about this, Tim?
Well, the interesting bit is that NASA appointed a research director to oversee its effort investigating sightings of these UAPs. But they're not going to name exactly who this is because of potential security.
Yes, exactly. Does he even exist?
Does he even exist? I think that's him in the suit right there. I guess, I mean, okay, fine, whatever. I guess this is what NASA is designed to do. And I guess if things are out there, and who knows, they might be, you need somebody to maybe keep watch on their skies.
Well, they might be anomalous. And that would be a terrible thing.
Yeah.
I mean, is it X-Files we're looking at here or something more like Resident Alien? We'd have to see. But you know where we won't be able to watch it is on ABC, potentially, unless you're an Nexstar customer, because it looks like ABC might be getting sold to Nexstar, or Chris Palmieri and the team just reporting that out now, that the whole network might get sold off by Disney, not just the local stations, which had been in the mix before. Now in the network and all of the local stations could be getting sold to Nexstar. We don't have a price or anything like that yet, but it wouldn't even be too difficult regulatory-wise.
Yeah, this news crossed the wire a little while ago, and again, it's based on, you know, Bloomberg reporting, citing people familiar with the situation. But I think the idea that our reporting is basically saying these talks have already been held. So we've gone from just, okay, this might be an idea, that Iger apparently is now actively shopping this around. Whether he gets the price that he wants, I guess that remains to be seen.
Yeah, Nexstar, we should note, according to people who we did not identify because the discussions aren't public, would only be interested in this at the right price, Simone. I think the question is you know, what does this do to Disney in terms of assets that they do want to shed, in terms of legacy linear TV networks that they want to shed, and then perhaps the impact that has on the direct consumer streaming division, which we know is really what the company's focusing on.
Well, and ultimately they're going to need content, right? It has to come from somewhere. So even if they want to become this, you know, direct-to-consumer business, you know, if you give away ABC, where do you get all your stuff that you're showing to consumers?
But also, we just had this blackout, right? Charter just had this huge tiff, let's say, with Disney. I don't want to call it a fight, but, you know, there was a blackout there for several days and it had to pay up to get these assets back. And does this mean now that Charter is going to be annoyed because suddenly Disney doesn't have ABC to offer? And how does that all work? It sounds complicated to me.
I mean, I think that's the big picture here is the idea that in the future, these traditional media companies are just going to bypass the middle people, right? The Charters, the Comcast, and go direct to consumer. Part of that deal did include Charter, of course, offering some of the company's direct to consumer offerings. We're going to keep talking about this throughout the program today. You guys have a great program. We have a great program. Let's check back in with each other in just under an hour when we all come back for Beyond the Bell. It happens weekdays at the U.S. market close. 4 p.m., we're going to take you through today's market close.
Continuing our coverage right here on the close, about 50 minutes until we get to the close of trading, at least going on in the public markets. We want to focus right now, though, on the private. No asset manager has really benefited more from the boom in private credit and private equity than BlackRock. It recently revamped, though, its nearly $300 billion alternatives business in an effort to capitalize on that growth. Edwin Conway was leading the alternatives unit. He's shifted into a new role, now heading a group devoted to venture capital, private equity, infrastructure, and growth equity investing. Pleased to say that Edwin joins us right now here in Studio 2 as BlackRock's global head of equity private markets. First of all, congratulations. I think the last time we spoke, you had a different title. This is a shift,
yes,
not just in what you do, but really in, I think, the way BlackRock views the private capital space, and more importantly, how your clients view it.
No, it's absolutely right. One, thank you, Romaine. Good to see you again. Hi, Vonnie.
Hi.
It is the notion that alternatives are alternative. We talked about it before.
Mm-hmm.
To us, it's no longer true. When you take a look at the majority of the allocations our clients are making today, from an institutional standpoint, we see at minimum in private markets today, our clients have an allocation probably 20% up to 50%.
Mm-hmm.
Wealth is probably more true. It's still in its infancy, but still a tremendous amount of demand and growth. So you're seeing anywhere from 2 to 5% of an allocation. But the reality is they're thinking about it in concert with their public market exposure. It's not one versus the other, it's one and the other.
Mm-hmm.
So as we take a much more holistic approach to the portfolio of the future, it has to involve private markets as a critical ingredient for success. So calling it alternative, we don't see that to be the case anymore. And so now what we've started to do is really pivot towards those private markets, the equity side, the debt side. And as we continue to bring the BlackRock muscle to this, as we believe, I think the advantage we've amassed over 35 years of BlackRock is the ability to source, particularly with corporates, this unique deal flow that we think in a world which is still confused, still uncertain, hopefully create differentiated alpha. So we're excited about the future, and probably one other new venture that I know we've mentioned in the past too, is our focus on transition capital.
Right.
Like this world is in transition. To us, that's one of the largest investment opportunity sets across our industry and for all of our clients.
Explain that a little bit more here. I mean, I think a lot of our viewers know what you mean, but when you talk about the opportunity for that in this particular environment here, is this something that is much more structural, meaning that this is more of a permanent sea change in business and the business cycle?
Yeah. It really is.
Yeah.
And it comes down to, in many cases, customer preferences. You know, we're facing two extraordinary headwinds today. Like consumer spending has shifted. And it did so during the pandemic, where you had a huge demand for services that automatically flipped to goods. When that happened, that created tremendous supply chain challenges. And what you started to see is then the world react and inflation pick up as a result of these supply chains that just weren't able to cope with this new demand. Then you've seen an extraordinary shift in demographics. Aging population, baby boomers are retiring. So we have a fundamental shortage of labor now in the US. If you think about where we are today, and I'll get through to why transition makes sense. Pre-pandemic, per unemployed person in the US, you had 1.2 vacancies.
Okay.
Today you've over 2. As you look at then the expected employment per month going forward and per year, we think the employment creation in the U.S. going forward is 0.5% post-pandemic versus 1.5% pre-pandemic. And so as we tie it into maybe the early discussion of AI, technology, and technology is a critical part of every industry, every sector, but also the decarbonization of many of our industries.
Yes. Edwin, equity private markets, what are valuations like there now, and where are there opportunities? Where is the equity in the private markets?
Yeah, Vonnie, it's still high. And you saw, actually, for many of our clients, the denominator effect really hurting them. So the unfortunate thing in private markets, year to date, you've seen in the first half, about 37% less capital deployed in the first half of this year versus the peak in 2021. 67% less realization than the peak in 2021, which goes back also to the question, is now the time to access the public markets? Are you starting to see more strategics so realizations happen? Because of the resetting in valuations, activity is picking up. The unfortunate thing is, though, you have $2.49 trillion in private equity sitting in dry powder. So what you will see is a dearth of capital come to play. Activity will pick up, hopefully in public and private, but valuations have started to more normalize. Things have gotten cheaper, but I would say from a PE standpoint, I would prefer being in the secondary market today than in the primary market, because at the points now that we can access, I would think, advantageous deal flow for our clients, you're accessing it at about a 15 to 18% discount at most recent NAVs, which have already come down.
So just to be clear, so you're finding that at least with price discovery in the secondary market, you think that's been more right-sized than in the primary market. Is that effectively what you're saying?
Well, I think it's certainly helping with price discovery, but what you've also seen is as clients are starting to think about the reallocation of capital, and this goes back to the transition conversation, they're thinking about infrastructure now in a much more profound way. Private credit. So there's a rebalancing happening amongst the asset classes, where the dominant asset classes of private equity and real estate in the past, it's not that it's going away, but there's a rebalancing towards a demand for yield, demand for diversification, and then this resilience they want to build in the portfolio, because we're still living in pretty uncertain times.
Edwin, how does it really work? Because there aren't all of these wealthy clients coming in saying, I want to jump on that decarbonisation train, I want to jump on that ESG train. These are all things that have been around for decades, right? These people want to ensure that they create wealth, and soon. So how do you jump away from these trends that are sort of out of trend anyway?
Yeah, it's interesting. We used to focus on asset classes in the past. Hasn't gone away, but themes are starting to permeate it through every single one of those asset classes. Decarbonization, or transition as we would call it, is certainly one of those. And when I say that, if you think about the digitization of the world, everybody wants to be on the internet. Yet if you look at the US today, and we just did a venture with AT&T called Gigapower. We created Gigapower with a very storied US organization. Why? 46% of the US population has access to fiber. The rest do not. So I think about the investment opportunities. How do you bring more equality to each and every one in society in each and every state in the US? It allows us to enable internet access to millions of homes. That in itself is, in our mind, a great investment that is sustainable over periods of time, but allows for us to take advantage of a trend that's not going away, because the digitization of this planet, this world, this society really is accelerating. I'd say the other thing we're seeing, even just with innovation, I think maybe it was on your show a day or two ago, Ascend Elements. So we do a lot of battery investing. Battery technology has been absolutely transformative. When you look at what Ascend Elements does, one of our clients' biggest concern is what happens when the battery stops working? It stops recharging, and the utilization goes way down. Do you have landfills of battery? Well, the answer is no. What Ascend does, it takes the old battery, lithium ion, and recycles 98% of it and brings it back into production, so the EV market continue to rise, but in a very cost-effective way. So I think, Vonnie, for the clients who are coming in on the wealth side, diversification that comes from like a Gigapower investment that we make, a growth or venture-like investment with Ascend Elements that provides a different type of return profile. But in our minds, independent of the uncertainty, actually across private markets and each one of these asset classes, there's a richness of opportunity set. You just have to work very hard to find it.
Fascinating conversation. I'm sure we'll be speaking to you again very, very soon, Edwin. Thank you for coming in. That's Edwin Conway, Global Head of Equity Private Markets at BlackRock. And coming up this hour, we'll have an exclusive interview with famed short seller Jim Chanos, why he told Congress that China poses grave financial and geopolitical threats.
Plus, I'm getting some insights into the factors driving the acceleration in investment in private markets. David Hunt, President and CEO of PGIM, also going to be joining the big show in the next hour. Stick with us. A lot more coverage coming up. This is Bloomberg. All All right, welcome back to The Close. Let's find out what CEOs are thinking. Boston Consulting Group recently released its CEO outlook. It found that almost 3/4 of chief executives expect macroeconomic uncertainties to be a key challenge. But at the same time, 79% are optimistic about their company's performance and 72% are planning cost reductions and other efficiencies. Rich Lesser is joining us right now. He's the global chair of the Boston Consulting Group, one of the big three, of course. And obviously the data you guys put out, these surveys, everyone pays attention to them. And it seems that CEOs, I mean, I know by nature they have to be optimistic, but they seem to be kind of maintaining that, I guess, rosy outlook.
So I do think part of being a CEO is to maintain a sense of optimism amidst all the turbulence in the world. But if you compare where we were a year ago, when people were worried about a world of either spiraling inflation or a severe recession, and you look where the world is today, and another great day on the market, but it's been a great year so far, I think that there is a sense that, you know, we are approaching a soft landing, still with risks, and that feels better. I just wrote a piece a couple days ago that was titled "The Hard Edges of a Soft Landing." And I do think we have to acknowledge that part of inflation coming down, part of a slow growth environment, is it's still hard to drive performance. There's going to be a lot of pressure on productivity, which is reflected in the survey, because wages are still outpacing inflation now, and you don't have pricing power to just pass it on to consumers. So that's a challenge, but overall it's a challenge against an optimistic backdrop.
But we've been talking a lot on this program about the so-called efficiencies. I mentioned it in the intro. And when I would look at the reports and your data and some other CEO survey data out there here, there's concerns about cost, but you don't necessarily hear as much concern just about pure revenue growth. Are you also hearing the same thing?
I think there's going to be more and more attention paid as people realize how much less pricing power they have to how to find the innovation, how to deepen customer relationships. AI is going to play a big role in that to be able to drive growth. And that was actually one of the main points I highlighted, that I think this focus on innovation is going to be a complement to the focus on productivity in a world where growth is tougher to find.
Rich, how are CEOs thinking about labor right now? Because it seems on the one hand, labor is very difficult to find, especially services labor is very, very difficult. Unions have some power and so on. On the other hand, it feels like the Fed is looking for layoffs and there needs to be more layoffs, and particularly the finance industry is laying off people left, right and center and right-sizing.
I actually think most companies made a call a year ago that they realized how much the human capital side was going to be a limitation to their future success, and they've been resistant to take on layoffs. And we've seen it in the data, we've seen it in unemployment rates. The good news is core inflation has dropped dramatically, in contrast to what people said, which is unless unemployment spikes up dramatically, we can't bring inflation down. We are largely bringing inflation down, and yes, because of fuel prices that went up in the last month. But overall, I think most companies are looking to avoid substantial layoffs, but they are searching for productivity. That's for sure, and AI is a part of that journey, as we're seeing. And
productivity is certainly up, but you're saying that what the Fed is looking for, which is some kind of drop-off in the labor market, it may not materialize?
Well, we've seen some. You know, the amount of open jobs has come down some. We've seen a moderation, a slight uptick in unemployment. I think what the Fed is learning, and we watch them learning, and they share that with us, is that the dramatic expectations for what we need in unemployment to bring inflation under control have proven not to be true. And I think most companies are recognizing that if they don't invest in human capital with the rate of change going on in the world, they're going to fall behind. It doesn't mean you don't search for productivity, but you don't just use cutting people as the way to hit your numbers in the next quarter. It's far more costly than it appears.
You mentioned AI a lot, and I'm told that you guys now have a partnership with Anthropic, right?
Yeah, that's the latest one.
The latest one. But I am curious because this is focused more on AI, kind of the safety around it, I guess the guardrails, if you will. And we just had all these tech CEOs yesterday. They went to that closed-door meeting with Chuck Schumer and other senators because we know at some point there's going to be legislation, regulation, how long that takes and what it looks like, who knows. But when you talk to these CEOs, they're kind of already moving forward with this kind of stuff.
Oh, I think so many CEOs. I mean, just for us. I think we've been in 1,000 senior executive workshops just in the last 8 months. We have more than 100 client engagements going on about how to embrace AI, and particularly now generative AI, and where you get real value from it. Because everybody reads this hype, but how do you get real value? How do you combine generative AI with predictive AI, and how do you do it responsibly? That is the question that is permeating so many executive suites right now.
Rich, we have to leave it there, but good luck at UN General Assembly Week. That is Rich Lesser, Global Chair at the Boston Consulting Group. From New York, this is Bloomberg.
Interesting day for U.S. equity markets. Vonnie actually setting up for what's going to be their best day of the month. And that comes on the back of the economic data, which certainly mixed, but it seems to continue to show that this economy is resilient.
And you know what else is resilient? The U.S. capital markets, it would appear, because we had an IPO today. And we also have this talk now about Disney selling off ABC, the entire of its network of ABC and its local TV stations. And we have indices higher by, roughly 1% apiece.
Yeah, up about 1%. All of the major indices getting in on the action here on the day. And like I said, we look for these windows of opportunities, right, where things can come to market. It's not so much about just ARM, right? It's about the idea is, are the capital markets functioning in the way that people want them to function? And at least for today, they're getting some signals that that's the case.
Exactly. ARM now at 58.87, so up 15.4%.
A lot more coverage coming up here as we keep an eye on the public and the private markets. A conversation up next with Jim Chanos. This is Bloomberg.
This is the countdown to the close. I'm Scarlet Fu, joining Romaine Bostick. We know that Washington is scrutinizing China and wants to better understand the threat that the country may pose to the global financial system. So Congress called up famed short seller James Chanos, a longtime China bear. And in his prepared remarks, Chanos said, if China is unable to pivot its economic model, either due to reluctance or inability, it poses global risk. The question is whether China can ever wean itself from its debt-funded real estate investment while simultaneously keeping their economy afloat. Now, bad weather prevented Jim from making it to the House hearing earlier this week, but he has made his way into our studio today for an exclusive conversation. Thank you for coming in.
Thank you for having me.
And the weather cooperated this time.
The weather is beautiful in New York today.
All right, well, you say China's economic model, which is driven by investment, is all about growing GDP at almost any cost. The thing is, Xi Jinping, the Chinese president, isn't exactly playing by that playbook right now. He's intentionally downshifting, holding back from doing more to stimulate the economy. Do you understand Xi's ideology, and do you think it'll work?
Well, I think that Xi Jinping is a change from the leadership we saw prior to him coming in 2013. Previous leaders since Deng Xiaoping really put economic growth first and foremost. And with Xi Jinping, I think it is more about party ideology and things like national defense. It's a much more muscular China than we've seen in previous decades. And this raises sort of the global risk level of what happens if the economic model falters and we see some sort of other efforts, whether it's increased defense spending or foreign adventures, to distract the Chinese populace from what's going on with the economy.
Okay, we can get to that a little bit later on, but I want to talk about the cost of the economy for now. Do you have a sense of how bad China's credit losses could get? Because I've heard one estimate of up to 42% of GDP from 31% last year, not just in real estate, but across other sectors too, like technology, for instance.
Well, we saw this once before. When China entered the WTO in 2001, they had to clean up their banking system. Now, back then, the debts were mostly to state-owned enterprises. But when all was said and done, about 40% of the loans were bad. Now, that number would be horrific because China's so much more leveraged today than it was back then. I don't know. We don't have a number on what we think losses as a percent of GDP would be, but certainly that's in the ballpark, the numbers you quoted. In fact, if anything, that might be a little bit low. So it's a bad problem. And it's the real problem with the economic model, Scarlett, in that if you never write off the bad investments, right, your GDP is inflated because you're borrowing money to put up, another airport or another high-speed rail link that's uneconomic. And that resides ultimately in the banking system with the debt related to that. And so that's the inherent problem with the investment-driven economic model. Sooner or later, the diminishing returns on these investments begins to make a difference.
Do you think other people, though, have woken up to that? I mean, we're still talking about a nation that still has a lot of foreign direct investment, despite some of the challenges as of late.
Well, I think people have figured out the risks. When we turned bearish on China back in early 2010, I think the New York Times ran not one but two op-eds ridiculing the call. And so, it was just after the Beijing Olympics, and China was unstoppable. And I think now people realize it's a little bit more accepted that this investment-driven model has real risks. So, look, I mean, China, we get tarred with the brush that we think China's going to be in smoking ruins, and it's not.
No.
It's going to have to downshift its economic growth, and it's going to have to make a transition from this model to a more traditional model if it's going to keep growing at a reasonable rate. And that's why we think the speed bumps that'll occur when they try to shift to a consumption or service-driven model will be more severe than people think.
It doesn't seem like much of a shift just yet, but I am curious with regards to Western investors, maybe dialing it back just a little bit here. Is that because of the economic model? Is that because of the economic decisions, or is it more tied to some of the political decisions and social decisions?
I think it's two things. I think you've hit it right on the head with the political risk, and tied in with that is governance risk, because Western investors have rediscovered the risks of the so-called VIE structure, which is the structure that Western investors have to use to invest in Chinese entities, because direct investment is basically prohibited. So we have the situation where if you buy stock in Alibaba or JD.com on the New York Stock Exchange, you're buying shares in a parent company sitting in the Caribbean, which has an economic agreement with the underlying businesses in the People's Republic. And if anything goes wrong, you have very little recourse to the assets inside the People's Republic.
So when anything goes wrong here, people look for a Fed put. They look for the Federal Reserve to ride to the rescue. What will it take for the Beijing put to kick in?
So I've always said that there's two things that Western investors count on in the last 10 years, that central banks will ease and China will stimulate, right? So every time we see a slowdown in growth, the call comes for China to spend more. The problem is you're just kicking the can down the road. And as I've said a couple of times, at some point the can kicks back. And if you have a bloated more and more debt in the banking system, more and more of the debt is being used to pay the interest on the old bad debt. And inevitably, that can't last.
It can't last, so that's why people do expect some kind of big bang stimulus. Would a big bang stimulus or the current drip feed of targeted measures that we're getting right now present a better opportunity for investors like you?
Well, again, we're not investors in China, so let me be clear.
But you could be betting against in different ways.
Oh yeah, of course. And so I think that stimulus is expected. I think that stimulus does nothing but just, in effect, add to the debt problems. I mean, in effect, if you have investment 40 to 50% of GDP every year, you're always stimulating. Literally, once you finish a building or a bridge or a rail project, you have to put up another one because the GDP drops off immediately once it's completed. And this is the inherent problem with the model. You just constantly have to be sticking a shovel in the ground. And sooner or later, the returns on the marginal project just don't justify the amount of capital put in.
Scarlett mentioned that you were supposed to testify at this House Select hearing. And we know that most of the Congress people, at least the ones at this particular hearing, are concerned about the economic linkages and the political linkages. The idea here that if the economy is weakening, as most outside investors seem to think it is, despite what the official numbers tell you, that this could exacerbate some of the political and, more importantly, some of the military issues that I think we're all fearing.
Yeah, I saw a report today that someone respectable pointed out that they thought Chinese defense spending was much higher than the sort of official $300 billion figure, that it was much closer to $1 trillion. And that would put its spending as percent of GDP higher than the U.S. So this is concerning certainly members of Congress and the administration, I think, as well as other countries in and around the area.
But what's concerning is that you can't give that number, and I don't know anyone outside of China that can give you a reliable number on that or the economic data. I thought the whole entrance to the WTO, the embrace of some modicum of capitalism over there, was to create more transparency around what's really going on there. And yet I feel today, here in 2023, I probably know a little bit less about what's going on there than maybe what I knew, I don't know, 15 years ago.
Well, I think it gets back to your political risk question, which is, I think the country has gotten less transparent in the last handful of years as Xi Jinping has increased his grip on power. And so towing the party line and making sure there's no bad news becomes paramount, as opposed to getting the amount of information that other investors need to make decisions.
You mentioned earlier China's foreign adventures. What do you think policymakers underestimate about the linkage between China's efforts to transition its economy, the challenges inherent in that, and its foreign adventures like saber-rattling in Taiwan?
Well, I mean, I think that there's a myriad set of risks there. Just the general amount of defense spending. China's increasing its spending on its Navy, for example, to make a blue water Navy. And so all of these issues raise alarm bells for our allies in the area, Japan, Australia, Philippines. But what I worry about is a miscalculation. Right? Things happen in this world, and history tells us things can happen. And you get an incident where someone, fires a missile they shouldn't fire, or whatever, and suddenly you have a crisis. And what we don't want is this Cold War, which seems to be growing, becoming a hot war. And as more and more planes and ships are in this congested area, sort of trying to claim sovereignty or exercise their right of passage, the chances of something bad happen. And I think that's something that everybody should worry about.
There's also a Cold War on trade and on economic relations between the two countries. Do you think Congressman Gallagher's committee and its work on the Chinese Communist Party will have any influence on the field of finance? Will this scrutiny lead to any changes in the way that Wall Street or financial people think or behave?
Well, I mean, I would like to echo some of the things that Jay Clayton said in his testimony. I think that one place to start would be reforming some of the rules that Western investors invest in and through Chinese instruments like the VIE's accounting standards. I mean, that's sort of my world, and I feel comfortable in saying that should be tightened up. And I think that the whole idea that you're investing in shell companies that the Chinese, by the way, the Chinese courts do not recognize. It really is problematic, and I think that some reforms there would go a long way.
Yeah, I think Archegos found that out the hard way. I am curious, though, how much do you think China needs at this stage Western investment, external investment? You talk about this idea of them becoming more of a consumption economy, sort of turning inward, something Xi Jinping himself has said explicitly here. Is that realistic?
Well, the good news in all of this is that the cross-border risks right now are not huge, right, in terms of banking problems transmitting into Western financial institutions. It's basically equity and debt investments direct through pension funds and mutual funds, ETFs, and others. It's a couple $1 trillion. It's not. It would not be the end of the world. On the other hand, you'd notice it. I think that the real issues are going to be internal to China. That's what I'm more worried about, and how China deals with it internally without necessitating more Western direct investment. I think they can get by without more direct investment, but they like it.
They certainly like it here, but it gets to the idea that if there are problems there, everyone wants to know about the contagion risk. As much as it could potentially be contained, we're still talking about a behemoth of an economy, not just in terms of the dollar, the value of its in size, but also just its reach. I mean, the amount of investments that it's made in so many other emerging market nations throughout Africa and Latin America and Asia as well.
Commodity demand.
Yeah.
Think about that. Yeah. And so. Of course. I mean, China is inextricably linked to the global economy, and will be in ways we don't even, fathom yet if something should go really wrong. And I tried to keep my remarks to the committee really attuned to the economic model and the financial implications. But sure, I mean, there's broad ways in which China is connected, both directly and indirectly, to the global economy that would pose some risks.
Do you think the comparison of China to Japan that we saw 30 years ago, the slow bursting of the Japanese bubble, is that a valid comparison?
I think it is. I mean, I used to have a slide in one of my presentations. It's like, who am I? And I had this list of sort of attributes: directed economy, reliance on real estate markets, right down the list. And people thought I was talking about China, and it was really Japan in 1989. And we know what happened, right? Japan kicked the can down the road for so long that it had 30 years of its hollowed out economy. And so there are some parallels. Obviously, there's lots of differences.
Yeah.
Japan's a Western democracy and had an open currency account would be the two biggest differences. But in terms of the economic model, Japan was running investment around 30% for years. And finally, paid that price. And by the way, the Asian tigers in the 90s had investment levels above 30% for about 4 or 5 years before that faded.
A lot of people are wondering whether we'll eventually see a decoupling of the Chinese economy with global financial markets. What do you think?
Well, I mean, the Chinese market has been a terrible place to invest for the last 10 to 20 years. The Chinese economy, if we believe the numbers, has quadrupled in size, and the equity markets are flat, maybe even down a little bit. And so it's been a terrible place for Western capitalists to invest, by and large. Obviously, there's some individual issues that have done well, but broadly speaking, you were well advised to avoid China for the last decade.
Yeah. All right. Jim, Chanos, we're just getting started here. We have a lot more to discuss, including some of your short positions across the U.S. markets as well. Still ahead, we are counting you down to the closing bell. We have a market that is higher right now, Romaine, on some better than expected economic data.
Yeah, still some hope here for that proverbial soft landing out of the latest economic data we got in the U.S. here, but this is still a global story. Yep. You saw what the Kristin Lagarde and the ECB had to say earlier this morning.
Dovish hike.
Yeah, dovish hike. We're not out of the woods yet. Stick with us. We'll be back in a moment. This is Bloomberg. This is the countdown to the close. Romaine Bostick alongside Scarlet Fu with about 10 minutes until we get to the closing bells. A relatively strong day for the broader market. I think maybe even somewhat of a surprise given the economic data we've had this week, which seems to suggest that, well, there's resiliency, but maybe not enough.
There's resiliency, even though rates are going to stay higher for longer, and people seem to be okay with that. The S&P 500 above 4,500 once again. While we don't see this reflected in the indexes, ARM jumped as much as 22% in its trading debut. We have bonds lower, so yields higher. The 2-year yield above 5% right now. And of course, the euro weaker versus all the G10 currencies after a dovish hike out of the European Central Bank. Yeah. This is just as much a strong dollar story today, which is at a 3-month high against the euro after those retail sales and PPI numbers rose more than expected. And WTI remained at 1 point above or getting closer to $91.
It is, right around there. I love to correct you on air, Scarlet Fu. We should point out that ARM shares right now hitting session highs, now up 23%.
Oh, there we
go.
So
a minor correction to 22, 23. But we won't quibble over a 1 percentage point there. But still, a very strong day here. A lot of people looking for some opening in the deal space. And of course, a lot of hype right now around artificial intelligence and how that translates into corporate fundamentals. Jim Chanos still with us over at Chanos & Company to talk about, we spent a lot of time talking about China, but I do want to talk about kind of the hype mill right now around artificial intelligence. Certainly there's got to be some substance to what we've been hearing over the last few months.
Oh, I think of course there's substance. It's a technological advancement, and there will be companies that clearly benefit. But what everybody forgets is that in these leapfrogging moments for technology, there's as many losers as there are winners.
Well, let's talk about that because everyone's drawing comparisons to kind of the dot-com boom, right? We had kind of at the end of the 90s, early 2000s, the internet became this thing. And we know there are a lot of companies that never really made it out of the graveyard. Quite a few companies that are stars today, like Apple and Microsoft and the like, that sort of came of age in that space too. Are there not parallels now?
Well, there are, and to my point earlier is that when the internet came, any business that was in the business of selling something that was analog that became digital was in trouble. Though think about companies like Eastman Kodak, right?
I covered that company well.
Film went to digital, and so their entire business model collapsed. And if we're seeing the same kind of situation with AI, there'll just be entire industries that are affected positively and negatively. And I think it's too early to tell. I mean, that's the thing. We're in that nirvana phase now where everything benefits from AI.
But everybody's throwing money at it right now.
Oh, that's Wall Street. You would expect everyone to throw money at a hot story. Come on.
Everyone's thrown money at Tesla for a number of years now. You've called it the it girl of the pandemic rally, post-pandemic rally as well. Is there an it girl of the AI bull market?
Oh, I suspect it's probably NVIDIA, which had the monster earnings back in May and again in August. So I would hesitate to say that there's something that's even more of an it girl for AI than NVIDIA. Might be out there. I don't know it though.
Okay, so NVIDIA is possibly the it girl at the moment, but the previous it girl, Tesla, you are still short on, but using options, yes?
We are. We're short the stock, and we just think it's ridiculously overvalued.
Right, but betting against it has not worked out yet. What do you think would prompt...
I've noticed.
Right. What do you think would prompt the market to be convinced of your take that Tesla is just a car company, nothing more?
Well, again, the Tesla story keeps changing, right? Every few months, the Tesla faithful trot out it's batteries, it's robo-taxis, now it's AI. And I'm a little bit bemused, having followed the company as long as we've been following it, that Tesla sort of admitted just recently in its full self-driving effort that it had been pursuing sort of the wrong avenue for 7 years. And that it's now going to a different type of software development for the next iteration of full self-driving beta. And so I'm just sort of wondering, this technological leader just told you that they basically were doing the wrong thing for 7 years. Now, my problem with that is they've been selling it as a product. They've been selling full self-driving since 2016. It doesn't exist. And so... this is, but this is a company that has gotten a wide berth from regulators in all facets of its.
It's gotten a wide berth from investors too, particularly amongst the retail set. And I am curious. I mean, as someone, as a short seller, and as someone who's been doing this for so long, you've seen how the execution of a short trade has changed. At least how, to a certain extent, it's become harder. Right? I mean, you can't necessarily do things as much out in the open as maybe you could have, I don't know, back in the WorldCom or Enron days. How much harder is it to execute that?
Well, I think you also have to watch your position sizing. We use options, as Scarlett indicated. The options market has gotten dramatically more liquid since 2019 than it's ever been. When I did Enron back in 2001, Enron's options were illiquid. It was an $80 billion market cap company, and the options market was fairly illiquid. Today, I have shorts on our books that are $2, $3, $4, $5 billion market cap companies where the options are more liquid than the shares. That's a big change.
That is a pretty big change. One of your big shorts since last year has been data centers. And I know that we talked a while ago, you were also bearish on commercial real estate, even before the March banking crisis. How are data centers similar to commercial real estate?
Well, data centers are basically seen as REITs. In fact, they are in REIT form for the most part. And so real estate investors have been gobbling them up recently because of AI, to get back to Romaine's issue. And so people are assuming just automatically that the legacy data centers will benefit from future AI demand. The problem is AI hastens the obsolescence of the old data centers. That is, the infrastructure that's in the guts of an old data center is not compatible with the new AI architectures. And you don't have to believe a short seller. You can see what Meta has written about this and other observers have talked about in terms of changing the architecture that the hyperscalers Amazon, Google, and Microsoft have told you. This is going to be a whole new set of data centers that are needed for this architecture. And so the data centers trade at 80 to 100 times earnings, and the earnings aren't growing. And in some cases, the companies have negative free cash flow. So it's not exactly a safe REIT. And we don't even think they're really real estate companies, Scarlet. We think they're technology service companies. And if you look at the financial statements, you would see that the returns on capital are really low, and they're heavily leveraged.
All right, Jim, we're going to have to leave it there. This was a great conversation. Appreciate you taking time for us here on The Close, Scarlet.
Yeah, we love seeing you. We welcome you back again to tell us about your next new position.
Thanks
Jim Chanos there over at Chanos & Company as we move closer to the closing bell. Stick with us. We're full market coverage coming up as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friends Tim Stenovic and Simone Foxman. Welcome to our audiences across all of our Bloomberg platforms, television, radio originals, and our partnership for those folks watching this on YouTube. Market screen across the screen here, Tim Stenovic. But before we dive into that, I do just want to bring some breaking news across the Bloomberg terminal a little while ago. Another big headline on Walt Disney Company. This time, said to be cutting their target for Disney Plus streaming subscribers. Remember, a little bit earlier in our show, we told you about the news here that Disney is exploring a sale of its ABC News business, and now further reporting by our crack Bloomberg staff here, learning that Walt Disney expects to fall tens of millions of subscribers short of its last publicly stated 2024 target for the Disney Plus streaming service.
Okay, we had a great conversation with Chris Palmieri out in LA and David Weston here in our studio. Of course, David spending many years at Disney, many years as president of ABC and ABC Television, ABC News, I should say. And David made the point that when it comes to content, even if this deal were to happen, that it sort of depends on the structure of the deal when it comes to content from the network being included on streaming services. Because a big question I have is Bob Iger looks to, like he said, everything's on the table when it comes to potentially selling assets. How do those asset sales affect the content available in the streaming push that he's doing?
All right, hold that thought here for 1 second, Tim. We just want to get you the closing bell numbers here in New York. What has been a very positive day here. Maybe that's partly because of the economic data. Maybe it's partly because of the latest IPO to come to market. ARM having a big day, up more than 20%. The Dow Jones Industrial Average going to finish the day higher as well, up by about 1%. The S&P 500 closing above that 4,500 level, up about 0.8%. Similar move on a percentage basis for the NASDAQ Composite. And the outperformer on the day, believe it or not, the Russell 2000, higher by about 26 points or 1.4%.
I feel bad for Simone on days like this where she has to find decliners. In the S&P 500, 433 stocks in the green today, moving higher. Only 68 of those stocks in the S&P 500, Scarlet, in the red.
Yeah, more than 5 stocks higher for every one that is lower on the New York Stock Exchange. So when you look at the sector groups in the S&P 500, no surprise, everything is green. Banks, real estate investment trusts, and auto companies are leading the advances. They're each up by at least 1.5%. The laggards here are healthcare equipment companies. They're barely positive. Diversified financials, interestingly, given that banks are higher as a group. Diversified financials gaining about 0.2%, and pharma companies just barely eking out a gain as well.
Well, let's take a look at some of the gainers on the day today. Shares of ARM really popping toward the end of the day today. We were talking about them hovering around $58 a share. Look at that, closing up more than 24% to $63.59 on their first day of trading. The company raising $4.87 billion in the year's biggest IPO. We know what happened today. The big question is what happens in the next few weeks, what happens in the next few months. Is this going to be a catalyst for other IPOs from the companies that have been on the sidelines over the last couple of years? It's been the deepest, longest listing drought since the financial crisis back in 2009. Let's take a look at shares of Disney with all of this breaking news happening late in the day. Shares still higher by 1.2%, despite the headline that Romaine gave you moments ago about adjusting its own forecast for its own streaming subscribers, up 1.2% on the day. This after Bloomberg News reported that the company's held exploratory talks about selling its ABC network and TV stations to local broadcaster Nexstar Media Group. That could bring in $4 billion, according to estimates from Bloomberg Intelligence.
And we should just point out real quickly, Nexstar also had a pretty good day, up more than 5% at the close.
Yeah, so investors could optimistic that a deal could be beneficial for Nexstar too. You don't often see that, Romaine, when it comes to potential acquisitions, right? The company that's doing the buying sometimes gets punished when that news comes out. Again, nothing has been confirmed at this point, just reporting from our team. Let's talk about AT&T. Shares of the company finishing higher by 3% today. We heard from the company's CFO at the 2023 Bank of America Media Communications and Entertainment Conference. The company said it expects third quarter free cash flow in the $4.5 billion to $5 billion range and remains on track to generate full-year free cash flow of better than $16 billion. Investors certainly happy to hear that news.
Yeah, Tim, I have to point out that it was challenging to find some decliners today, but I did do it. But they're not down super much. HP, though, falling as much as 2.5%. Looks like it closed the day down 1.8%. As Warren Buffett's Berkshire Hathaway disclosing that it had sold a close to $160 million stake. Remember, Berkshire Hathaway, one of the company's largest shareholders. So this adding to some of that disappointment around the outlook that it put out last month. Bloomberg Intelligence also saying that it reinforces rising concerns about the printmaker's ability to stabilize and grow free cash flow in the immediate term. Also looking at shares of Robinhood, they were down a bit more earlier in the session, but now closing down about 0.5%. They're reporting monthly active users for August at 10.6 million, but that's down from July's 11 million, and Goldman Sachs says that's below expectations. Also, finally, looking at Visa, this is an interesting one. We got news after the close yesterday in a filing that the company is exploring ways to allow some of the largest banks, which are shareholders through a very unique share structure implemented pre-IPO, to sell their shares, up to half their stakes. So the market's kind of digesting exactly what's happening here. We're seeing shares down a little over 2.5%, but Morgan Stanley says this may reduce uncertainty. Meanwhile, Jefferies says they expect to see some near-term skittishness.
Well, as far as what went on in the yield space, interesting moves higher in yields pretty much across the board here. Your two-year yield now moving a little bit deeper into that 5% territory here. And we should point out it was a pretty volatile day. Of course, anytime you have big economic data, you're going to see these big swings. But the net effect is a modest uptick in yields here at the close, 4 basis points on the 2-year, 3 basis points to 4 on the 5 and the 10-year, and your 20-year yield and 30-year right now also up about 3 to 4 points. So almost really, when I look at this now a little bit closer, almost a parallel shift here in the yield curve higher.
Yeah, definitely. All right. And of course, we talk about this idea that the case for a soft landing has been building. The Atlanta Fed GDP Now model now shows a move lower. They're now looking for real third quarter GDP of 4.9%, so below that 5% mark versus 5.6%, a few weeks earlier. I wonder how you fold rising oil prices into that, right? Because that's just been going up and up.
All right, I just want to we actually are getting earnings, believe it or not.
Still,
earnings season never ends, as Katie Greifeld always likes to remind me. Adobe crossing the wire right now. Those numbers coming in, at least as far as their fiscal fourth quarter numbers, the adjusted EPS, 410 to 415. That's the guidance that they're giving, guidance for the fiscal fourth quarter, 410 to 415. Now, even the low end of that range is above the average of analyst estimates here. As far as their forecast for fourth quarter revenue, $4.98 billion. We'll just round it up to $5 billion. To $5.03 billion. And again, the lower end of that range is about on the nose, was what the street was looking for on average. Now, as far as the quarter that just passed, the fiscal third quarter here, also a beat on a couple of key metrics. Only minor beats, though. 409 on EPS, a minor beat there, and $4.89 billion in revenue, also a minor beat on that. Shares up 2%, about 2% here in after-hours trading.
Yeah, and what's interesting here is that analysts are going to be looking for some signals about how corporate budgets are looking. Corporate budgets have been tight, but do they see stabilization in the New Deal pipeline? We will hopefully get some more commentary on that as we hear from the executives later this afternoon.
We actually spoke to a president at Adobe yesterday. He was on our program. Adobe made a big announcement about Firefly and the corporate tools that they had available, the enterprise tools. What's that?
I used to love that show.
The show Firefly?
Yeah.
Well, look at what's on the screen right now, this generative fill that they can do, Romaine. We talk about AI and what companies are promising with AI. Yeah. They said they've been working on this for 10 years, and this is legit stuff here. Wow. I mean, they're literally generating images out of nothing. I mean,
it's really cool.
It actually is really cool, and there's some. They argue serious economic implications for the company of doing something like this.
I feel like this is going to be available on the iPhone in like 2 years.
Yeah, it's a really good point. You can search for just people doing demos of this on TikTok. It's actually a thing.
You know, one thing to keep in mind when we do get to the conference call is whether the company says anything about Figma, which is looking to buy, but of course the EU has been stopping them and saying, wait, we got to look into whether this dampens competition. And of course, this is a huge strategic purchase for Adobe.
I do want to go back to the Firefly thing, because I think we talked to the same person yesterday. And it's interesting, too, because there was always this idea here that most of these AI tools, at least in terms of being revenue generator, is going to be much more about selling to corporations, right? The idea that the applications there had much more profit potential. But Adobe had talked a lot here about kind of catering to just regular folks, if you will, the people that would use a Photoshop or Illustrator or something like that, and that there was actually a lot more opportunity there, at least in their view, than in some of the other spaces.
You know, but the challenge, I think, for the workforce, not so much for Adobe, is do people lose their jobs because they have all these tools at their disposal? Now, I will say the president of Digital Experience, who was, I think, on both TV and radio yesterday, didn't really answer this question.
No, he didn't
have to
answer.
say.
No, I mean, look, we're all losing our jobs at some point, right? I mean, that's just the way it works.
Someday.
But
I'm doing
the reality check there.
But in all seriousness, I mean, that's still so far in the future. I mean, in terms of like en masse, when it starts to really replace things. I think most people say that's so far in the future. But you had all these executives in Washington yesterday. I mean, not necessarily the right executives, but you had some big executives there. And I mean, my main takeaway is that there really are no guardrails right now. I mean, companies could kind of do what they want, and by the time Congress catches up, well, they're going to be behind.
Yeah, I think catches up is the key phrase there, Romaine. Do you think they actually understand?
No.
The members of Congress understand what,
No,
should be regulated?
I seem to remember hearing from just 2 years ago where people were still trying to explain them, how Facebook sells ads, and that was just 2 years ago. So you think they understand AI?
Sir, we sell ads.
Yeah.
I think that's what Mark Zuckerberg said. Guys, that is going to do it.
Tubes, my friend.
That is going to do it for our cross-platform coverage. Coming up, we're going to be seeing you tomorrow, same time, same place. Don't go anywhere, though, because we got much more of our program coming up in a minute, and you guys are doing more on TV.
We are going to take a deeper dive into those earnings out of Adobe that just crossed the wire a little while ago. Stick with us here on Bloomberg Television. The close continues after the break. This is Bloomberg. The dearth of new equity issuance here in the U.S. finally seems to be broken. ARM, the chip designer that was controlled by SoftBank, coming to market today here in the U.S. Biggest IPO on a year-to-date basis, and it was a pretty good day. A sale at 51 overnight here, and open around 56 and a close above 60. A pretty strong day here, not only for that company, but a lot of people really trying to extrapolate whether it ends up being, well, a harbinger of things to come for the broader market. Is enthusiasm out there? Is risk appetite out there? That still remains to be seen, but you're looking at a market that has put together a string of relatively decent gains. Modest gains, but somewhat sustainable to be sure, at least when you look at the breadth of what we've had over the last few days. Back at 4,500 for the S&P 500, back near 1,900 for the Russell 2000, and the NASDAQ now trying to break free from that 50-day moving average that's been like a little bit of a magnet, a force field, keeping it tethered. Your two-year yield, though, still remains elevated, as does much of the rest of the yield curve here. A focus on the economic data and, of course, a big focus on what's going to happen next week. The Fed begins that two-day meeting on Tuesday with the big decision on Wednesday and, of course, the big press conference. No real changes expected in policy rates, but could be a big day here when we get the economic projections and, more importantly, whatever commentary Jay Powell thinks the market needs to hear. Of course, before we get to that, we're going to have to deal maybe with the potential spate of volatility tomorrow. Triple witching when we get those big options expirations all on the same day. Remember, volume on the market, at least across all the tapes, has been relatively subdued here, well below what we've seen on the average on a year-to-date basis. That's most likely going to change in a big way. We'll see whether that actually has an effect on market sentiment or this becomes more, Scarlett, just a technical event.
Yeah, and of course, we're also keeping an eye on earnings because they are still coming. Adobe just announced results about 10 minutes ago, and what we heard from the company is a third quarter beat, or I should say fiscal third quarter beat because it was for last quarter, more so on the bottom line than the top line. So let's bring in Anurag Rana. He is Bloomberg Intelligence Senior Technology Analyst. Anurag, give us your take on these results because we know that there was a lot of concern about the digital experience, which had been affected by weak business IT spending.
Yeah, I think, overall, we are encouraged by all the metrics in constant currency growth rates for all the three segments. And I don't see, anything that concerns me at this point. We'll see what they say on the call about next quarter's guidance and business activity. But so far, whatever we see, we like. It looks like we are seeing stabilization in IT spending at this point, which is something we saw both from Amazon and Microsoft.
And of course, there's a lot of talk about AI. The first line in the news release, or the second line, I should say, is we are unleashing a new era of AI-enhanced creativity around the world with innovations across our portfolio. And of course, we know that Firefly, the creative generative AI models, has sort of been priced. It's going to be cheaper than OpenAI. Anurag, what more do you expect the company to say on its earnings conference call on this?
I would love to see any numbers around initial adoption of some of these technologies or some of the use cases. Now, in the case of Adobe, I think it is one of the easiest beneficiary of generative AI because the company has a lot of data underlying, and that's kind of what I would say is commercial-ready data that can be used to create images using AI prompts. A lot of other companies don't have that because they need to figure out how to train those models on customer data. But in this case, Adobe has a lot of pictures inside that can be utilized for generative AI.
So this gets us to this idea, though, here, too, about how accretive it can be to the business in terms of actual, not just revenue growth, but also profitability, Anurag.
So, Romaine, think about it this way. If you are a graphic designer and you can create pictures on command, anything that you write and you really don't need to go to a graphic designing school to go out and create, images or be in a marketing team. You can just be a normal graduate and come out and do a lot of this stuff. So I think this does unleash the product to a brand new set of users that was not part of Adobe's TAM before that, or the total addressable market. And I think it really is going to help Adobe a lot more than other enterprise software companies that we cover.
Well, I guess it gets to my next question on Anurag, which is that when do we actually start to see that here? Because when I look at the forecast for the fourth quarter, I know this is kind of still early in terms of the AI tools and that, but when do we start to see a meaningful uptick in the guidance with regards to what they're going to make in the future?
See, think about it this way. If the product is available, widely available, let's say a quarter or 2 quarters away from now for everybody, they have a Creative Cloud base of about $11 billion. There is no logical reason why you shouldn't see an 8 to 10% or even a slightly higher uptake into that base because of the accelerated demand for some of these services. This is really, as I said, one of the easiest use cases of generative AI that I can see.
That being the case, Anurag, I'm curious what you think is going to happen with the Figma acquisition. We know that Adobe announced this back in September as a $20 billion deal. There was a lot of excitement around it, but then the EU, its antitrust unit, opened up an investigation not so long ago, and there's real questions about whether this will close. I mean, this is of pretty important strategic value at this point to Adobe, isn't it?
See, we have said this many times, we think Adobe is going to be fine with or without Figma. This company has a massive install base. It has a product that is loved by millions of people. I really don't think Figma is going to be that big of a game changer. A lot of other people disagree with me. I think Adobe will be fine without it also. I don't think that is going to be a big deal in my view.
Anurag Rana, the best of Bloomberg intelligence out there in our Chicago bureau. A look at Adobe. Shares unchanged here in after hours trading with the beat for their most recent fiscal quarter and a raise in guidance for the quarter to come. All right, a lot more coming up here on the show. We're going to sit down with the new CEO of RingCentral, Tarek Robbiati. We're going to talk about AI and his vision for the future of the software company. That conversation coming up after the break. This is Bloomberg. Okay, ARM, of course, was the big talk of the day. The chip designer making its NASDAQ debut with shares trading well above its IPO price. It's also been 10 years since software company RingCentral celebrated its IPO. They had a big banner there outside of the stock exchange there. And they're now looking to blaze a new trail for connectivity using what else but artificial intelligence. And they have a new man to helm that strategy as they move forward. Tarek Robbiati joining us right now. He is the relatively new CEO of RingCentral, about 3 weeks into the job, and formerly he was the CFO over at Hewlett Packard Enterprise. Great to have you here in the studio in New York.
Thanks for having me, Romaine.
I know you're still early in the job and getting your feet wet here. This is a big transition. You're taking over for effectively the founder of the company, and I'm sure that has to be somewhat daunting that when you have somebody who has that kind of vision and now he says, I'm going to hand the baton to you and do what you can.
Yes, absolutely.
Yeah.
And it's wonderful and very deeply humbling and honoring to be in that position, to be the second ever CEO of RingCentral. And Vlad is iconic in the UCaaS space. He has really spearheaded unified communications well before anybody, and he created a fantastic company that is in a very select club. One where companies have more than $2.2 billion of recurring revenue annually, and it's truly remarkable. And I'm here to take the company to the next level. He's still around as executive chairman, and we intend to grow the company and scale it up much more than what it is today.
When we talk about sort of the type of technology that RingCentral has, the way it sort of allows everyone, all companies to connect and their employees to connect here, and I think about all the talk about artificial intelligence, it seems like that's kind of a match made in heaven. Did RingCentral already have a presence in that space?
Yes, we do. In fact, AI is something that has been in use in the industry for quite some time. But obviously, the series of circumstances have led to the entire world focusing on it since the beginning of calendar year 2023. And we've been using AI technology to really infuse a lot more intelligence in the way people and companies communicate. And so if you really think about contact center solutions, for example, they use already AI. And the big bet is that the use of AI technology will help drive significant increases in productivity and competitiveness to the next level. Think about it this way. If you think about a conversation, a lot of things can happen with AI before the conversation takes place. During the time the conversation takes place, as you analyze what's being said, you summarize it and so on, and after, a lot more after the conversation, because what AI can allow you to do is to really action tremendously what has been said. And you can think about many different things. You can think about spearheading a marketing campaign or decide to kick off a purchase order. Lots of opportunities exist in our field of unified communications to really turbocharge productivity and competitiveness through AI, and that's what I intend to do.
Those opportunities, though, require investment. I'm wondering what you see as spending on this AI capability, what that will look like in the next year versus the next 5 years.
Yes, I mean, it's early days to call the investment figure. We believe that we have great capabilities. We have hundreds of engineers at RingCentral that are capable of really building AI solution and enhancing what we already have. I'd say from our vantage point, our goal is to continue to grow the company and accelerate the growth, making sure that it remains healthy in doing so in terms of calories and bottom line profitability. I would say that our investments will be around people, some systems, but it's not going to be reinventing everything from scratch. What's really important is that we use tools and AI techniques that have existed for quite some time and put them to use, stitching them together to suit our case and use cases from our customers. That's what we intend to do.
Integrate them into your existing functionality, in other words.
Absolutely.
So
exactly that.
let me ask you about the rise in hybrid work. Obviously, that's something that helps a company like RingCentral, but now that everyone wants their employees to go back into the office, how are you seeing that play out in the utilization of your services?
Well, we obviously benefited from the pandemic, like many other players, when everybody was remote, right?
Yeah.
And the reality is that the world is coming back to normalcy, and so are we, by the way. We want to make sure that everybody in RingCentral comes back to the office as we invent new stuff. But the world is also different post-pandemic than what it used to be before the pandemic. The world is much more hybrid. There is a degree of flexibility expected by employees, which we respect. Well, we're going to be looking forward to bringing back people together to continue to invent and to strategize and solve complex problems. And that requires people to be together. And most importantly, a collaboration platform like RingCentral that allows people to really and truly communicate in an integrated fashion across video, messaging, phone, in any circumstances and in any place you are, you can use the same app to do so.
There's obviously a growth story here that investors are looking to. What about the cost story? Have you been forced to sort of take a closer look at the costs that the company has and change them?
Yeah, Romaine, the way I look at this is like a fitness test. We all need to go to the gym and find ways to be lean and mean, and there's no difference around that now. And it's been done by the team at RingCentral. If you really analyze our performance, the team has done tremendous progress in expanding operating profit margins. Right now, we are guiding the market at about 18.5% operating profit margin for the end of this year. And we feel very good about it. And we are on our way to continue to expand revenue and in doing so, grow operating profit.
Are you comfortable with staffing levels where they are right now?
I would say so. Broadly, I would say so. I will have to take a closer look, but I think my focus has always been, walk and chew gum, make sure that we can continue to grow, and at the same time do so profitably. And if I see opportunities to be more efficient, I will take them.
As far as the revenue growth, do you think most of that's going to be organic? Are you actually considering any sort of M&A strategy?
First and foremost, organic growth is what's more important. And M&A is just a tool to turbocharge the growth story. Eventually, we may look at opportunities if they make sense strategically and financially on the M&A side.
Tarek, really appreciate you taking time for us, and congratulations on the new role. Got a lot of work ahead of you, and hopefully we can talk again. Tarek Robbiati there. He's the CEO of RingCentral. Here on The Close, we have a lot more coverage coming up, including an exclusive conversation with the head of PGIM, David Hunt, going to be joining us after the break. We're going to get his thoughts on a wide variety of topics. You don't want to miss that. This is Bloomberg. Welcome back to The Close here on Bloomberg. We're going to turn now to the growth of private markets. As investors seem more willing to move into less liquid assets, and asset managers have taken notice. David Hunt is the president and chief executive officer over at PGIM, which recently boosted its private alternatives business. David, great to have you here in the studio.
Thanks for having me. It's nice to be back.
I think the last few times we've spoken a lot about private markets because, quite frankly, that seems to be what clients are interested in right now. How has that evolved in terms of what specifically they're asking for?
It really has changed a lot, Romaine, in the last year or two. I would say that we've had a bit of a front row seat at this. I mean, we're at $300 billion in AUM, AUA. We're probably one of the largest private alternative managers. But our footprint is a bit different in that we didn't start with private equity. We really started with real estate and much more of a bent toward private credit. And in fact, that's been what's growing really quickly for us. It's been real estate debt to some extent, infrastructure, and some of the more specialized forms of debt, including private credit. And what people, I think, don't appreciate is that this is not just a short-term phenomena. This is a change in how the economy is being financed. If you go back 10 years, banks did all of this. Banks did lending to middle markets. Banks did infrastructure. Banks did project finance. They aren't putting money into these markets. And so institutional investors are stepping in and doing that, and it's being architected by asset managers such as ourselves.
But as sort of more clients become interested in this, of course, you have to come up with ideas for new ways to invest this money, new products, if you will. We were speaking a little bit earlier with Edwin Conway, who heads one of BlackRock's main divisions, and he kind of made the point, I mean, as I'm sure you know, alternatives in the old days was just that. It was real estate, commodities, and that was about it. And now it's just so vast. And I know PGIM is now exploring new businesses, including something like reinsurance.
No, the alternatives definition really is much broader. And I think that if you look out 5 to 7 years at an institutional investor's portfolio, you're going to see a higher proportion in privates. You're going to see a higher proportion in privates that are debt-oriented, and you're going to see, I think, fundamentally much more variety in the types of strategies. So let's take the one that you mentioned, which I think is a great example, which is reinsurance. So obviously, PGIM owned by Prudential, we have benefited from
an insurance company.
We've benefited from being able to invest with insurance liabilities backing that for 50 years. In the last 10 years, a number of the private equity firms and others have sort of figured out this magic a little bit to get in. And so what we did announce last week was a big step forward and a new platform that we're developing together with Warburg Pincus to make reinsurance much more available to institutional investors.
So they have another option, in other words.
They do, and what's important, I think, about this this reinsurance announcement that we made is that it's not just a transaction. We actually announced a platform. So while the transaction was the reinsurance of some prudential liabilities, this is set up so that we can do many more types of those transactions, and we can do other third-party insurance companies. So while I'm delighted at the $10 billion in assets to be able to manage in that, this will, over the foreseeable future, grow to multiples of that as we get more and more reinsurance assets in. And this is a powerful growth driver for PGIM because, two of our big growth areas, one is this private alternatives we've talked about. This fuels a lot of that. And solutions. More and more clients are looking for ways that they can actually use multi-asset class to drive returns and diversification. And this is exactly what they're looking for.
Okay, multi-asset classes, driving returns. Your clients want increased allocations to private assets, private credit in your case. What is this increase coming at the expense of? What are they making room in their portfolio? What are they not buying? What are they not spending money on or putting money into in order to make room for private credit?
It's a great question, and I think there's a longer-term answer and a shorter-term answer to that. Because right now we're in this kind of strange period where many of our clients have obviously had all of their public securities marked down a lot as interest rates rose very rapidly. Their privates didn't come down so much, and we can argue about the legitimacy of that. But in any event, they didn't. So they have this problem where right now on their asset allocation, they're over-allocated to privates. So they've got to work themselves out of that a bit. In the very near term, they've actually taken money in the last 2 years out of public fixed income to fund a bunch of this. That is about to change. And I think the real bellwether for this is when we have assurance that the Fed has topped out and is beginning to move down. And when that happens, we're going to see an enormous shift back into public fixed income. And then where's the liquidity going to come from? Equities. Public equities have been in outflows among institutional investors for quite a long time, particularly active. And I think that probably continues.
But when we talk, if that ends up being true, is that because of the return differential? Is it because of the risk differential? What?
It's all of the above. I mean, I think it's partly that it's easier to have real alpha in the private markets. Many public equity managers, net of fees, have struggled to beat index funds. And they've run too close to the benchmark. And so in our strategies, we run, much higher concentration pieces and don't have that problem. But the industry overall has. So you've got better returns after fees. And you've got better diversification because the private markets operate on a different cycle.
Well, you talk about the idea that, of course, when we get a sense of that, the Fed has sort of ended its rate hiking cycle, that maybe ends up being the inflection point. I have to ask you about some of the economic data we've gotten. I mean, what do you make of it? Because I can look at that economic data and say, yeah, the Fed probably is done. I can look at that same economic data and make a case that the Fed is going to do more.
Yeah, it's very hard to know exactly when we've hit that. I think we can say with some assurity that they are a lot closer to the top. Whether we can completely call it or not, I don't know. But I think that the piece that the markets have wrong is that I think there's this view that somehow the Fed will kind of somewhat rapidly begin to come down. And our view is the economy is stronger than most people think, at least in the U.S. We can talk about some other. But in the U.S., it's stronger. The labor market is stronger. And that means that rates are going to stay higher for longer than the market's currently priced in. At least that's how we're positioned at the moment.
And with rates staying higher for longer, the dollar continuing to stay strong, what does that mean for the appeal of U.S. assets, whether it's in public markets or private markets from overseas? You travel the world, you talk to clients all over the world. What are they telling you?
They're saying that, gee, David, talk to us about the hedging costs, because they believe that the U.S. is going to outperform in terms of the kind of local currency alpha that they can create. But the dollar has been very strong. And so for the most part, they are hedging it back into euros or yen. And when those costs get very expensive, this whole trade really comes under some scrutiny. But at the moment, they're able to hedge that, and we are seeing many of our clients overweight to the U.S. at the moment.
You said earlier that investors are making room in their portfolios for private assets by not being in, say, public fixed income markets now, and down the road maybe public equities. The thing about public markets is they're liquid. What is your confidence that private assets, private credit, will be liquid when investors need them to be?
So liquidity is, I think, one of the most important issues in all of that, because, of course, these markets are not liquid. And indeed, part of the reason you're getting a spread over publics is you're getting paid for that illiquidity. And I think that people need to construct their portfolios knowing that that is true, and knowing that they won't be able to immediately get liquidity on that. Now, I will say that over time, there are ways of mitigating that. And one of the best examples of that is, the secondaries market. So, for many years, if you were in private equity and others, you were kind of in there for the duration. We have a private equity secondaries business that's actually extremely busy right now, because clearly a lot of people are saying, I have too much private equity, but I don't have enough money to allocate to new private equity. What's the solution to that? The secondaries market. And so we will see these become more liquid over time as other secondary markets grow up in real estate and in private credit.
I am curious, looking forward here, David, what's the big risk that you are keeping your eye on right now?
Well, I think that whenever you get in a situation like this where debt has grown pretty dramatically over the last 5 or 6 years, and even before that and before COVID, you saw pretty big rises and the kind of search for yield. So we're keeping our eye really clearly on areas where there's a lot of leverage. We are watching the CLO market closely. We are watching some of the private equity firms that have actually levered up, at the fund level as well as at the individual level. We're looking very closely at the bank loan market. So there are clearly areas where there's been a lot of leverage put in, and I think we all need to be a bit careful in those areas.
We always appreciate your candor. David Hunt is CEO and president of PGIM.
Thank you.
Thank you so much. All right, coming up, the economic and political ramifications of the United Auto Workers strike, which could come in the next few hours. The deadline is what, 12 a.m., right?
Yeah, midnight tonight here, and we've already hearing some commentary out of some of the car executives saying not a lot of progress has been made. That story coming up after the break. Stick with us. This is Bloomberg. Welcome back. We want to bring you some breaking news here on the close. Earnings for Lennar, the big home builder, crossing the wire just a little while ago. Their fiscal third quarter numbers coming in slightly above estimates here. $8.73 billion of revenue in the most recent quarter. The street was looking on average for about 8.5. Adjusted EPS coming in at $3.91. The street looking for $3.51. Here's the forecast going forward here. The company saying that in the fourth quarter, its fiscal fourth quarter, it actually sees deliveries of around 21,500 to 22,500 here. The lower end of that range is above the average of estimates. The company also saying that new orders themselves will be at 16,200 to 17,200. The lower end of that range slightly below the average of estimates on Wall Street here. But once again, we're talking about a company that has had a phenomenal run, at least for the stock price as well as for its order book, Scarlet, here at a time when a lot of people thought that the housing market would just tank.
Yeah, and instead there's plenty of demand, and the stock moving slightly lower in after-hours trading at the moment. We are, of course, hours away from a possible union strike between the UAW and the three major automakers. This is an event that could bring shockwaves to the U.S. industry, U.S. auto industry, and, of course, the economy at large. Bloomberg Detroit Bureau Chief David Welsh joins us now. David, there has been some flurry of negotiations in this last day. We're getting some more details on some of the proposals as well, right?
That's right. General Motors put out a new proposal to the union today, offered 20% raises, which is up from the 18% they had previously offered, sweetened the retiree benefits for those who have an existing pension plan already. They didn't give in on pension for the younger workers, which is one thing the union really wants. They didn't give detail, but GM did say they offered some cost of living allowance, some inflation protection for workers. That's been another big issue. But it doesn't, so far we don't have any kind of release saying there's an agreement on this from the union, nor have they said that they're turning it down. But, it's been so heated the past few days that it's hard to believe this one is going to do it, but we'll see. We'll have to wait until about 10 p.m. tonight to get more direction from the union on where they want to go.
Well, I'm curious. I mean, we, of course, heard from Sean Fain with this live stream the other day here. So we have a general sense here of the strategy that the union plans to take, assuming they don't reach a deal tonight here. How much have we heard from the automotive executives themselves and how they will adjust should a strike take place?
Well, look, they're preparing for a strike in any way that they can. Mostly what they've said is they've just kind of voiced frustration with Shawn Fain's rhetoric and the fact that they've put out what they believe are very rich offers, only to be denied by the union. I think the companies think that the union is just determined to go out here, almost no matter what they put on the table, and that's partly because of this pension issue, this big sticking point. After 2007, any new hire got a 401k instead of a pension, and in the union's eyes, that was taken away. It was something they gave in the bad old years of the financial crisis and should come back, and the companies have no interest in doing that again. So that's where if there's going to be an impasse, that will be it.
Yeah, that seems to be a hard red line there for the unions. David, you've been covering Detroit, you've been covering the auto industry for more than 2 decades now. Does this impending strike feel different? Is what the union staying firm on different than what it has done in the past?
It definitely does, because first of all, we've got this moment here where we've got writer strikes and UPS, and you've got organizing drives at Starbucks and Amazon. This is a moment for labor these days. But this union leader, Shawn Fain, comes out of a reformer movement, and they believe that past UAW presidents have given up too much to the companies and never went to get any of it back. And the union did make a lot of sacrifices when GM and Chrysler went bankrupt, giving up cost of living increases, giving up pensions and retiree health care for new workers. And they feel that the companies are very profitable now, and they've seen CEOs get 40% raises over the past 4 years, so why can't they get 40% raises as well? And look, there's some logic to some of these demands. Others, like 32-hour work week and pensions, would be financially very difficult for the car companies. That's why I say this pension issue is going to be so crucial, because if the union wants to stay out a long time to try to get that, the companies will really dig in, and we could be in for a very long strike. Yeah. If the issues were just over cost of living allowance and pay, they can come up. They can come to an agreement on that.
Just real quickly, David, I was actually a little surprised about the pension demands here, because that really is kind of taking us back in time. Was that just kind of put in there as a negotiating tactic, basically ask for way more than what you want, knowing that something's going to get cut anyway?
That's something I thought all along, that's what they were going to do, is put that out there just so they could get good pay increases. But Shawn Fain keeps talking about it. And in this current body of union workers, 60% of them were hired after 2007 and don't have that pension. Yeah. And this has to be ratified by more than 50% of the workers. So if you're promising something or saying you're going to get these pensions for 60% of the, let's call it the voter base, and you're getting them excited about it, it can't be a bargaining ploy. You're setting yourself up for some real trouble if you're the president of the union.
All right, David Welch, our man out there in Detroit, keeping an eye here as we count down to midnight, where the UAW has threatened to begin that strike. And of course, this has some potential ramifications for the economy as well as for the president of the United States. The president has weighed in on this, trying to nudge both parties towards some sort of a deal. But quite frankly, the president's hands appear to be tied. Jordan Fabian, our White House reporter, joining us right now for a little bit more insight here as to how involved the Biden administration has been in these negotiations, Jordan.
So, Romaine, this is not like the freight rail dispute of last year, where the president got involved and basically imposed a contract on the parties and made sure that the freight railroads kept running. The president doesn't have that legal option. So he's basically been on the sidelines while encouraging both the union and the auto executives to stay at the table and try and negotiate a contract that meets both sides' demands. And as David just laid out, the sides are still pretty far apart.
I know I tend to use Detroit as shorthand for the different automakers and where their plants are located. But the truth of the matter is that the manufacturing plants of these automakers run up and down the Midwest. So it's a lot more than just Michigan. It's Ohio as well. Talk us through what this means in terms of how Joe Biden and his team think about what they're going to say to potential voters across those states.
Yeah, the elephant in the room, as you point out, is that this is happening right as the 2024 presidential campaign is ramping up. Those states are going to be critical, Michigan especially, for President Biden's chances of winnings. And some estimates say that a prolonged strike could cause a recession in Michigan. So, whether the president appears to be on the side of the union or not, what side the voters are on, if the economy starts tanking in those key Rust Belt states, that could spell political trouble for the president. And not to mention, this strike and or this union contract dispute has big implications for the president's clean energy agenda. At stake is his push to move the country toward electric vehicles. That's been a point of discussion here, a point of tension between President Biden and the union as well.
Yeah, and this has already become a political issue. I mean, Jordan, I'm sure, as you know, we've already heard from former President Donald Trump, who right now is still the leading Republican candidate for president next year. And he's kind of made it clear here that he's going to make this a political wedge issue if he can.
That's right. He's sent out a number of statements saying, look, the President Biden's EV agenda is killing the auto industry. You're either with me or you're with the left. And look, there's going to be a lot of union members who blow that off. Union leadership has said they're not going to endorse Donald Trump. But that could appeal to some union members who voted for Trump last time around, and it could soften support for Biden. There could be union members who decide to stay home or don't go out and organize for the president, and he needs all the help he can get in the Midwest from unions to win this election.
All right, so Jordan, there's a couple of hours to go before this deadline really comes and goes. What is the White House likely to do? Does Gene Sperling now, I mean, is he in Detroit? Does he force everyone to come to the table? Does he sit at the negotiating table?
So the president, last we know, talked to the union president and the auto executives a few days ago. I would suspect there's going to be some outreach to the sides today, whether it's Gene Sperling or the president. But it's important to know Gene Sperling is not at the table. He's been basically on the sides trying to smooth out communications, trying to encourage them to stay and negotiate and to not have a work stoppage. But look, the union leadership appears determined to push its demands, and that could lead to a strike come midnight when the deadline expires.
All right, we're all keeping an eye on that. We should point out the UAW has already scheduled a press conference for 11 p.m., so before the actual deadline itself here. We'll keep an eye out on this. Jordan Fabian, our man in Washington, and of course a full team out there in Michigan, keeping an eye here on what could be one of the more consequential strikes that we've had here in the U.S. in at least the last 5 years. Still ahead, we're going to set you up here for what to watch tomorrow on Friday. Yes, thank God it's almost Friday. This is Bloomberg. Welcome back to The Close. Let's set you up for what the markets will have their eye on Friday. And we start Friday in China, which is just a few hours away. A big dump of data on their economy.
Retail sales, industrial production, home prices, the jobless rate. The government's not even giving the jobless rate for youths anymore because it's gotten to a level where everyone just is, it's mind-bogglingly high.
Yeah, it'll be interesting to see what it says. Because remember, the last big batch of data we got wasn't necessarily good. I guess if you remove some of the bad data, then I guess it all ends up being good. I don't know. We're also going to keep an eye, of course, on the UAW strike. The big auto workers union set to strike at midnight tonight, but they've already scheduled a press conference for 11 p.m. Eastern time.
They're going to talk about what the plan is, how they're going to move forward with strikes, these targeted strategic strikes across the different manufacturing plants.
More economic data in the U.S. tomorrow, including the University of Michigan consumer sentiment data.
Yeah, a lot of eyes will be focused on the expected inflation expectations because that'll give us a sense of what the Fed's going to do going forward.
And it could be a busy day for option traders tomorrow. Triple witching here in the U.S. market. You usually see a pickup in volume. That does it for us here on Bloomberg Markets to Close. Appreciate you watching us. We'll be back tomorrow. Balance of Power is up next.